When you think about all the catalysts, the risk is not quite balanced versus the reward at this point.
The market's been fighting off kind of recession talk now for 2 or 3 years.
Tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
The strategists are getting negative. The traders, the investors are nervous about what this means.
If sustained, these types of tariffs could shave minimally 0.7 off of growth for the year, maybe even a full percentage point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a morning. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, dazed and confused. Your equity market bouncing back. Equity futures, your scores look like this on the S&P 500, advancing 0.6%. On the Nasdaq 100, up by 0.75%. On the Russell, up by 1.2%. The prospect of a trade compromise juicing equities this morning. But take a step back. Have a look at the global economy right now, and for that matter, global markets. Let's start with Germany. 2-year, 10-year, 30-year, double-digit moves on a German yield curve, up by 20 basis points on a 10-year maturity. That's Germany. Think about China, coming out with a 5% GDP target and pushing more deficit spending as well. We are seeing some changes in the global economy that people have been pushing for a long, long time, and it looks like we might get it.
We are getting an expansion potentially of the deficit in one of the countries that was the example of what it meant to not borrow any money, and that is Germany. The idea that they could expand their spending by 500 billion euros over 10 years for infrastructure on top of doing whatever it takes, the Draghi moment for their defense spending, is shifting the goalposts. Does it actually come through now is the question.
It's a regime change. It's a whatever it takes moment for Germany, and arguably for the global economy. We're seeing shifts we have not seen for decades upon decades upon decades. These are things we've been talking about for such a long time, and here we are. I think we've got to ask a lot of questions about trade, about fiscal policy. Let's start with fiscal. Just how much space is there for Germany to go through with what they're trying to do? And just bear in mind, I know we're not talking about this right now. I know the president's celebrating a big, beautiful drop in interest rates, and the bond market means a lot to them at the moment, and they're celebrating that. I've got all that. Later this year, they're still going to pass, at least attempt to pass, a major tax bill at a time when Germany is trying to push this through.
So on the surface, the U.S. is pledging fiscal restraint that looks different than what we're seeing, at least on the surface, in Germany, in China. What actually happens in practice is probably not going to be that. The U.S. is likely to expand its deficit, and you are correct, and you raised this point yesterday, and I think it is the question to ask. How much capacity is there left in this global market that is tired of potential inflation to finance some of this deficit spending that we're seeing around the world that is no longer focused just potentially in the United States?
Remember the Tariff 101 rulebook for financial markets? Tariffs on, dollar stronger. Tariffs on, dollar weaker. That's a big change, and that does not help. The FX channel is not assisting. Euro-dollar, I hope you paid for the vacation in Europe up front. Euro-dollar 107, new highs for the year.
George Saravelos of Deutsche Bank, who will be joining us later this hour, came out and said that this was a seismic shift, the announcement in Germany yesterday, that this caused him to change his view to bullish, outright bullish the euro versus the dollar with a 110 goal. 110. We're not talking 120. He's not talking about a new wave of growth. Suddenly, it is not just a question of the U.S. penalizing everyone else with tariffs. It's the idea that the rest of the world could see some signs of growth. At the same time, the tariffs more broadly have shifted to a degrowth, a disinflationary, a suppression to the U.S. dynamism.
George is going to join us a little bit later this morning. The euro stronger, the dollar weaker. We begin this morning with our top story. The president on the American economy.
For every one new regulation, 10 old regulations must be eliminated. The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. And I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
How much disturbance and for how long? The president's comment coming after Commerce Secretary Howard Lutnick suggested a deal to ease tariffs on Canada and Mexico, and that deal could be announced later on today. Annmarie joins us now from Washington for more. Annmarie, let's get straight to it. A compromise, how soon?
Well, when it comes to the Commerce Secretary, he said we're going to get that announcement today from the president. But it was interesting, of course, because the president didn't talk about it at this moment when he was addressing the nation. He could have talked about this potential off-ramp they have, what the Commerce Secretary Howard Lutnick called yesterday, meeting in the middle when it comes to Canada and Mexico. He said not going to be a pause, Howard Lutnick, but he said but the president is reasonable. We could see him meet in the middle. Instead, the president doubled down on his tariffs. He seemed committed to the cause. It was just in that moment, that key quote. There's going to be a little disturbance, but we're okay with that. Great question, Jonathan. What's the disturbance? Because you mentioned earlier at the top of the program, he mentioned the bond market. The president didn't mention the elephant in the room if you were a financial investor or the market, which is the fact that we did see a pullback when it comes to equity. So that's going to be a key question today when we speak to the Commerce Secretary. What exactly is the plan? Because yesterday, the president didn't sound like he was looking for any off-ramps when it comes to trade.
Annmarie down in Washington for us throughout this morning. Later on this morning, 8 a.m. Eastern Time. Do not miss this. A conversation with the Commerce Secretary, Howard Lutnick. A timely conversation coming up later on this morning on Bloomberg Surveillance. Joining us now to discuss, Peter Tchir of Academy Securities. Pete, good morning.
Yeah, good morning.
What a change we're seeing in the global economy. Where'd you start?
One, I think we're all talking about trade flows. We should maybe be talking about capital flows, right? One of the things that the U.S. has clearly benefited from the last several years is capital inflows. And I'm wondering if this time, as the dollar's weakening on tariffs, you're starting to see Europe grow. And that was just Germany doing, right? We haven't even seen anything out of the EU yet. And I assume they will follow Germany's lead because normally, they all dicker around for ages and ages. And then someone does something. All of a sudden, Germany, went straight to this. I think capital flows could become an issue.
The U.S. president and his policy at the epicenter of all of this. Love or hate U.S. economic foreign policy right now. It is at the epicenter of changes we're seeing in China, changes we're seeing potentially in Germany, arguably pushing them to do things that are good for them. What I'm trying to figure out from the capital story, are we seeing a policy mix in the United States that will attract capital or push it away? And are we seeing a policy mix in Germany and China that will pull it away at the same time?
I think both are true. I think we are pushing it away and it's starting to get pulled away. I think people are looking at this. I think, yes, we will get some concessions from these countries because they have to. It's very hard to live with 25% tariffs. But I think we've set in motion a real economic change where people are turning to other people. Again, you look with Canada and Mexico, and I think even Lutnick mentioned it yesterday, right? This went against the USMCA Act, which Trump had been part of putting on, right? So if you're a country, the president who put a deal on has now kind of changed the terms pretty dramatically. Yeah, you probably have to do some acceptance because you can't live with the short-term pain. But I think you're figuring out longer-term solutions. And so far, we've been saying China has become probably the big winner of this, right? We had basically bipartisan support that China was our biggest number one adversary. We were supposed to go after China. China seems to be playing this very coolly, right? They have not been coming to the table. They seem to be sitting there. They're going to do their own thing. I watch FXI and KWeb. I like those. I think they're going to outperform. They've been still outperforming even this morning with our little bounce in the U.S. They're having a bigger bounce in China. I think people are going to turn to them. They're going to be forced to turn to them, which is not a good thing for us longer term.
Let's put that into market terms. It's early days. It's only been 2 days. But what we've seen is dollar weaker and yields up. This is exactly what people did not want to see. How much do you think that this is a lasting trend? And how much do you think this is a blip on the heels of headlines that are going to be much more complicated to be put into action?
I think that we're going to move around, we're going to bounce around, but I think this is really the potential of a trend, right? Germany's going to need to issue debt. Europe's going to need to issue debt. China's going to need to issue debt. And the foreign buyers of our debt now might have more alternatives. Like, you know what, if I can get a better yield in Germany, do I want that? And our positioning's been so erratic. So, yes, the tariffs are only in place for a few days, but we've been talking about this basically since the election, since the inauguration, and it's been more heightened. And we're getting this back and forth. And also, I think part of this is Trump playing from as strong of a hand as we believe, right? Russia now has to come to the table at some point, right? Everything's been about Ukraine and peace. We haven't heard Russia's view on any of this, I don't think, how close we are there. All these other trading partners, what are they going to do? Some that's going to be reaction, but even you saw Canada trying to impose tariffs back. I don't think Canada can survive very long necessarily without finding other trade partners, but you're forcing that to happen.
We're talking about capital flows, but is there an absolute level at which, when you have so much debt already in the world and you have a number of countries that are looking to raise even more, does that elevate yields more broadly? Does this mean that we have a higher floor underpinning a lot of the bond yield space.
Yeah, and I think even, yesterday when yields were going lower for a little while, it's not affecting the long end anywhere near as much. I think most of the day, even when yields were rallying at the front end, as stocks were selling off, the long end, I think the 30-year was still slightly higher in yields. So we're at, 425 on 10s? You're not getting that movement in 10s and longer anymore. And I think that's because you are going to see competition for that space. And we are going to have questions about where the U.S. is headed on this. And I'll even go back to, they spent hours, it felt like last night, talking about some of the stuff Doge has found. It felt all fairly trivial, right? Where are the real billions and billions and billions of savings? And I was kind of personally annoyed. We went through the Social Security, and they talked about the 350-year-old person, 250-year-old person alleged. That's two people. Haven't we figured out from the records, do these two people exist? What's the situation? Like, there are ways to fix this.
They're 350. They probably don't.
Right, and they're probably not actually receiving Social Security, so let's just admit, okay, there's a coding error here or something, but it was trivial because the person wasn't receiving money anymore. So it felt like we're blowing these things out, and I'm not seeing, these real efficiencies that I was hoping to see, to be honest.
That's the United States. Let's sit on Germany just for a while. Can we put up the German yield curve? What a move we're seeing. 2-year, 10-year, 30-year. 10s right now are up by close to 20 basis points. When you see moves like that, I'm looking at the equity market, the DAX is rallying by 3%. I get it, people just see this as good news. But when you look at the bond market, is that move to accommodate extra issuance, or because we're looking at better growth, a better profile for economic growth across the continent?
Probably a little bit of both, right? I think those two are going hand in hand. There is going to be higher issuance, so that's going to have to come out. Again, Germany's been hard to own as a bond investor, right, because the yields are so low. So all of a sudden, I think they will see really strong demand for their bonds, and I think that's part of growth. And again, anything that solves Russia-Ukraine will really benefit, I think, the EU, right? Especially Germany. You are going to see rebuilding there. I think they're going to try and get in there. And that's, again, we're going to see this competition. I think, yes, we want the rare earths, critical minerals, so does Europe. There's going to be, I think, a lot of competition for being part of whatever, rebuilding occurs there.
So let's get to some trades. Longs you like right now, shorts you like right now.
So I continue to like China. I think I now have to add more aggressively Europe. This does feel like a real change there. I still do not like the NASDAQ 100, for example. That's kind of been I think that's still overdone. It might rally a little bit more. We might have some, decent trade news. So I'm less bearish than I was, a week and a half ago. On the other hand, we've had a pretty nice move. I think this continues to go lower, though. I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest in those, and it's going to impact the high flyers most. In the U.S., I have still liked some of the chip parts that are, more domestic makers. I continue to like anything that's going to be part of, he talked again, drill, baby, drill. We've been trying to say refine, baby, refine. And I think more what we've been trying to change the narrative is anything that's good for national security, that equals national production, you want that, because we are going to become more independent.
If an investor were to ask you, is the Trump put dead, that the Trump ability to come in and save the market, is that off the table? What would you say?
I think he doesn't care about that right now. I do think when I look at all the policies, everything he's said and done, the one theme that I think is consistent is if you say he wants a legacy of rebuilding manufacturing in the U.S., he wants to leave the presidency with a real middle class, he does not care about those equity markets right now, right? That's not his focus. It's things to get this job, and I think he is deadly serious when he says we'll have to go through some pain. So I think in his goal, he does not care about 10, 20% moves in the S&P 500 anymore.
Trump move, Trump put, reincarnated, come back as the bond market. The bond market gets the mention last night in the address to a joint session of Congress. We don't hear about the stock market at all. That's a shift. I think we've seen that shift building over the past month.
Is the decline that we've seen in yields so far this year considered a victory? And I want to ask every corporate executive officer that question at a time when potentially that means they could borrow more, but do they want to?
Opinions shift wildly from day to day. Just think about this. Monday on the DAX, the best day since 2022. Tuesday, the worst day since 2022. This morning, the best day since 2022. Peter Tchir, I can't keep up. Peter Tchir of Academy Securities, thank you, sir. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some more details from that joint address to Congress where President Trump defended his tariff plan, saying that it would raise trillions in revenue, rebalance trading relationships, and acknowledge that there could be some economic pain. Trump's speech focused on issues like border policies and DEI, with some discussion of consumer prices and inflation. Now, in Germany, the country will amend its constitution to unlock hundreds of billions of euros for defense and infrastructure investments. Chancellor in waiting, Friedrich Merz, has planned a 500 billion euro infrastructure fund investing in priorities like transportation, energy grids, and housing over 10 years. Goldman Sachs will look to cut between 3 to 5% of staff. A person familiar told Bloomberg that the latest round will take place in the spring, that is earlier in the year than usual. The Wall Street Journal earlier yesterday reporting that Goldman will focus on cutting vice presidents after hiring too many in recent years. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, teeing up a compromise.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them.
Is that compromise just around the corner? Joining us next is Dan Clifton of Strategas. And later at 8 a.m. Eastern Time, a conversation with the Commerce Secretary himself, Howard Lutnick. From New York City this morning, good morning. It is difficult to overstate some of the changes we're seeing underway in the global economy. Just amazing. Some major stories developing. Let's start with equity stateside. Equity futures positive by 0.6% on the S&P, up by 0.75% on the Nasdaq. We've got a bounce this morning. We're looking potentially for a compromise between the United States, Canada and Mexico. In the bond market, no compromise coming from the German government. A whatever it takes moment. The potential for a 500 billion euro infrastructure fund. Check out those moves. 20 basis point move higher on a 10-year bond yield over in Germany, pushing 270. These are huge changes for German fiscal policy. The front end of the curve up 13 at 216. And that ECB meeting just gets more and more interesting as the hours pass by. Under surveillance this morning, teeing up a compromise.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
So here's the latest today. Commerce Secretary Howard Lutnick suggesting President Trump may offer a pathway to tariff relief for Mexico and Canada. Lutnick's comments follow the market posting its worst two-day slump since December. Annmarie joins us now from Washington with more. AMH, we talked about this briefly. This is a shift already, a shift that didn't even last 24 hours of having tariffs on Mexico and Canada.
It's a huge shift. Howard Lutnick coming out, the Commerce Secretary, saying they're going to be potentially this olive branch. They're going to meet in the middle. They're going to be announcing it. What was so interesting, Jonathan, is that the president didn't mention any of it last night when he had this prime time viewing in front of the American public. He did say, though, there'll be a little disturbance, but we're okay with that. And that's the big question this morning. How much of a disturbance are they willing to take on when it comes to this White House and the impact tariffs are having on equity markets, which the president didn't even mention once yesterday? Let's bring in Dan Clifton. He's over at Strategas Securities. He's a partner there and, of course, head of policy research. Let's first start with Canada-Mexico.
Sure.
Commerce Secretary Howard Lutnick says potentially there's this pathway for a compromise. What does meeting in the middle mean?
Yeah, so let's just take a start from the beginning. Mexico and Canada were here negotiating last week. They didn't reach a deal. The president put 25% tariffs on both countries. And I just want to explain the magnitude of that. That's 0.5% of GDP. With retaliation, it's more. The economy is slowing. That would really damage both of their economies. It would damage the U.S. economy. So it just doesn't look sustainable at that level. And what the president's staff are saying is if there's more that Mexico and Canada are going to do, we can meet in the middle. Does that mean a lower rate? Possibly. Does that mean that maybe autos get exempted because they are complying with the USMCA? But there are some issues that the president's worried about, like Canada's digital service tax, which he thinks is a violation of USMCA. He wants to see Canada doing what Germany is saying they're doing by investing in their NATO budget. So there's a specific set of requests that they're probably going to need to get to. And I think the cudgel of putting those tariffs in place is speeding up those negotiations.
I'm glad you mentioned the auto sector, because last night President Trump did say very briefly that he spoke to the top 3 car makers, the CEOs, yesterday. And we know that the auto sector has not been happy with these tariffs. The Ford CEO is saying it's going to blow a hole in the industry. Is that what is your base case?
Yeah, so let me take one step back again. This is the equivalent of raising the corporate tax rate by 10%. And it disproportionately falls on these sectors like auto. So the auto companies are going to the president and his team and saying, this is existential. You like all that support you have from the union workers? They're going to be out of a job if this happens. And so that's what they're trying to do now. They start off very big, and then they work their way in and say, where do we need to provide relief? Autos are one potential area that's probably going to be top of the discussion.
So is it a lower rate for autos, or is it a carve-out?
So it could be a carve-out. And I don't know what it's going to be, but it could be a carve-out. I think that there could be a lower rate as well overall within the USMCA, where it's not just 25%. I think that number's got to go lower. Remember, members of Congress are going to be hearing about this in their districts. So the political blowback of putting tariffs on Canada and Mexico is very different than China. And they're going to learn that as it starts to feed into the home districts.
Yesterday, the president mentioned he likes seeing interest rates drop, big, beautiful drop. Didn't mention the equity markets once, but at the same time, we did see an equity market pullback.
Sure.
The Commerce Secretary showed up on Fox News and talked about this potential meeting in the middle. Is that where the Trump put is right now?
Yeah, I wouldn't say that. I think that this Trump is going to be more aggressive and less sensitive to financial markets in the short run. Annmarie, we just had a huge 30% run up in equity straight through last year into this year. We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty. It all makes sense to me. But what we're starting to see from the president is a major shift in policy, moving the country away from big fiscal policy and tight monetary policy under Biden and moving it in a reverse direction, tight fiscal policy, tariffs, spending cuts, and trying to loosen up the monetary policy, trying to get other countries like Germany and China to do things that we don't have to do. And when you look across the headlines this morning, you are starting to see that Trump is getting countries to do things that they have said no repeatedly. They're starting to come in, and the world is probably going to be better off for that. But there's a bit of a transition, and people are going to feel uncomfortable.
He certainly is internationally, especially when it comes to what we're seeing out of Germany and Europe writ large. But I have to push back on fiscal spending. The president said yesterday, we're seeking permanent income tax cuts across the board, then reiterated his calls for no tax on tips, overtime pay, and Social Security benefits. Well, how are we going to pay for that?
So if you look at where we are today, we're going to extend all of the Trump tax cuts. That means everybody's going to get the same tax cut next year as they get this year. They're then going to offset that with spending. So on net, you're going to have austerity in 2026, regardless. Is there going to be enough room to then put no tax on tips, which is a small tax cut? But what about a domestic corporate tax rate for manufacturers? That would be a big change, and it offsets some of the tariffs. But my sense here is that the deficit is going lower. We're going to have a huge April tax season because of the big run-up in the equity market, and you're starting to see some of the spending begin to slow. So as soon as we get out of tax refund season, which will be mid-March, and we start moving into tax payment season, you're going to start seeing the deficit come down. And I got to be honest, even if you do a half of the USMCA tariffs, that's going to be $75 billion of revenue alone. And you got $40 billion on the China tariffs. So the tariff revenue is picking up in places. It's just not taxes, so it doesn't look like taxes. And my sense here is the deficit will be lower by the end of the year.
We just have a few moments left. Quick question. Next week, are we headed towards a government shutdown?
I think that we could shut down. I thought that we were starting to make progress. Cooler heads were beginning to prevail. You're starting to see the bid-ask begin to open up. Democrats have to be very careful because if we go into a shutdown, then Trump can do anything he wants to shut down the government. Right now, he's restricted by some laws, and Republicans need to be careful. This is the way that they're presenting themselves to the U.S. The reason why I think Trump's speech was so important last night is that Trump's momentum was starting to wane. He was able to re-energize his supporters last night. A shutdown just kind of puts a big rut into that next week. So my sense is they're going to figure out some way to do a punt and do a temporary extension,
classic Washington,
build more roadway, and then try and buy them some time for a longer deal. But we're dealing in probabilities here, and I would just say that it's 50-50 on a shutdown right
Dan,
now.
thank you so much.
Thank you.
Jonathan, Lisa, Dan Clifton, their strategic securities partner. What I take away from that conversation is today, when we potentially get that announcement, Jonathan, watch the auto space.
Annmarie, appreciate it. More on that a little bit later on this morning. The day after the president puts 25% tariffs on Mexico and Canada, we have a guest on the program saying the global economy might be better off for it because of the things it's making China and Europe do. We'll talk about that in just a second. George Saravelos of Deutsche Bank on Germany's whatever it takes moment from New York City. This is Bloomberg. Two-day losing streak on the S&P 500, looking to snap that this morning. Equity futures positive by 0.6%. On the Nasdaq, up by 0.75%. On the Russell, up by 1.2%. 2 days of declines. We're down by about 3% over that period. In the bond market, we have seen a big, beautiful drop in interest rates. The President of the United States addressing a joint session of Congress yesterday evening, celebrating the move we've seen in the bond market. The 2-year at the moment, 396.76. The move in the bond market, though, and here's the wrinkle in the theory, the move in the bond market has been off the back of weaker than expected economic data. Don't lose sight of this later on this morning. ISM services. That might get lost in all the conversations about these big shifts we're seeing elsewhere. I understand that, but that data point is still important. ISM manufacturing beneath the surface was pretty ugly. Will you see the same thing confirmed by ISM services a little bit later?
At a time when a whole host of different economic data have all been pointing in the same direction. And right now, this market seems much more attuned to the idea of weaker economic data than it does stronger economic data. To your point about lower yields, there is a real question of whether these lower yields are welcomed by an administration that also wants growth and also wants to plug a deficit gap with incoming revenues. How much can yields go down before it is no longer a positive put on the economy?
And they've got a big tax plan they want to push through a little bit later this year. Shift to Germany. Check these moves out over in Europe. Euro dollar briefly breaking 107, 106.80 right now, positive by 0.5%. The equity benchmark in Frankfurt, Germany is higher by 3.4% on the day. And check out these moves in the bond market. The 10-year up 19 basis points. The 10-year bond yield in Germany, 268. I think we have to reflect when it comes to Germany on where they've been over the last century, conditioned by the experience of the 1930s. Absolutely determined not to repeat that. Conditioned by it, and therefore you get this situation. I remember this, and I'll share this story with you now. Wolfgang Schäuble, the former German finance minister, when he stepped back from government in 2017, people of the finance ministry went outside, stood in a circle dressed in black to celebrate the Black Zero. That was something they were very, very proud of. And the shift you're seeing, I really don't think you can overstate this. The shift you're seeing potentially in Germany with the prospect of a 500 billion euro infrastructure plan is absolutely massive.
Especially because it's being supported by some of the architects of that debt break that we saw put into effect, I believe officially in 2009, but leading up to it, with questions around how you emerge from that post-war period. A real question now of just how much gets passed, whether this is just the beginning at a time where that's for infrastructure. But we have heard whatever it takes for defense spending, and that is still to come.
More in Germany in just a moment. On our radar this morning, President Donald Trump promoting his tariff and trade agenda, saying any resulting economic pain would be a little disturbance that Americans would be able to overcome.
You and Annmarie both asked the absolute correct question, which is, what is little? What is disturbance? How do you define that? Is there a disturbance that is no longer little that they need to respond to? Is this basically President Trump saying, remember that that Trump put on equities? It is no longer in place. A question of what the ultimate goal is. And I'm very curious to speak with Howard Lutnick later in this show, because he will be talking about how there might be room for negotiation. I want to understand what the plan is, and then why President Trump didn't mention that or allude to that in any capacity, where he kept doubling down on tariffs and saying this is the path ahead.
If you're just joining us, the Commerce Secretary will be joining us in about 90 minutes from now, so 8 a.m. Eastern Time. Look out for that. Lots of highlights in the President's address yesterday evening, including this one. President Trump reiterating his demand for an end to the Ukraine-Russia war.
Regarding the agreement on minerals and security, Ukraine is ready to sign it at any time that is convenient for you. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Wouldn't that be beautiful? It's time to stop this madness. It's time to halt the killing.
So 1-2 boost for the Europeans and European markets. If you get peace, 1, you get spending, 2, that's the reason you're seeing these moves across the continent.
And we're going to be speaking with George Saravelos, who has changed his call. The point, though, that I really want to emphasize is people are changing their call to a little more optimism. This isn't a runaway type of move that we're seeing in markets, and there's still a whole host of skepticism that all of these things will come together. And when it comes to Ukraine and Russia, there's still key questions of what this path to peace looks like at a time where we've heard a lot from the Ukraine side. We haven't heard so much from the Russian side in terms of what the calculus is there.
Let's get to the German side. Germany would unleash hundreds of billions of euros for defence and infrastructure investments. Chancellor in waiting Friedrich Merz saying his administration will do whatever it takes to defend the country. Joining us now, Bloomberg's Chad Thomas in Berlin. Chad, welcome to the programme, sir. I think we have to take a step back and think about the history of all of this. The love affair with the so-called Black Zero. Is it facing a divorce?
Yeah, John, I was listening to you and Lisa talking this morning about that photo that they took when Wolfgang Schäuble stepped back as finance minister. It really can't be underestimated when we talk about what a shift we've seen overnight in Germany by the chancellor in waiting, Friedrich Merz. And we have to remember that this is his party that put the debt brake into place. And the fact that he's not only saying that they're going to spend this $500 billion on infrastructure, but basically they're going to take defense completely out of the debt brake and that they're going to spend whatever they need to on defense. We're hearing privately that will also be in the hundreds of billions. They don't want to say publicly how much they're going to spend because they've said they don't want to let the Russians know. But essentially, we're expecting that the defense side is going to be a huge pot of money as well.
You raise your group calling this fiscal policy on steroids. Chad, that's not something we typically associate with Germany. They've clearly got the willingness. Can we talk about the ability? How easy is it to get this through the German government?
Yeah, well, that's the interesting twist here. So in order for this to pass the parliament, they need a 2/3 majority. And they're concerned that the parliament that was just voted in, the election, of course, was only just a little over a week ago, that they won't have the 2/3 majority in there, in part because the far right did very well, as you remember, in the election, and they're not likely to support this measure. So they're going to use the old parliament to push this through. They still have a couple of weeks before the new one is sworn in. What it means, though, is Chancellor Merz, he, of course, has his own party backing this and the Social Democrats. They'll also need the Greens to support them as well. The Greens are likely to do that. But again, there's still a few steps here to go. But it looks like this will get through the parliament very quickly by German standards sometime next week.
Hey, Chad. A busy few days for you and the team, I'm sure. Appreciate your time. Chad Thomas there of Bloomberg out of Berlin. Check out the bond market this morning. Yields higher across the curve by double digits. Moves we don't typically see over in Germany, up by 19 basis points for the euro. New highs for the year. A stronger European currency against the dollar. George Saravelos of Deutsche Bank writing, it is hard to overestimate the scale of change taking place in global economic and geopolitical relations in just a matter of days. George joins us now for more. George, welcome to the programme. Let's start with your call on the euro. Talk to me about the change.
So there's really two key components, John. The first one is very much this shift coming out of Germany, which I would call generational. We have been expecting some sort of shift over the last 2 weeks. As soon as the election was over, it looked like the ingredients were building. But even we, and we've been on the optimistic end, were very surprised with the magnitude of the fiscal shift that was announced. From my perspective, it's the biggest shift in fiscal policy I've seen in my career, both in terms of magnitude and pace. And this has huge consequences for both growth, the ECB, and even Europe's strategic autonomy versus the US. So that is one component. And I would say the policy is increasingly shifting to be cyclically relevant, even in coming quarters, rather than just structurally relevant. And then on the flip side, you have a situation in the US where tariff policy is taking place in such a haphazard way, it ends up creating self-inflicted damage to the US economy. I think that is one reason why Fed expectations and US yields are coming down. And the broader fiscal picture remains very murky. So we have a situation which is the complete opposite from what I personally would have expected at the start of the year. But when the facts change, we change our minds. And that's what's happened over the last few weeks.
So, George, let's talk about a couple of things. Let's talk about this first. On Wall Street, as you know, there are certain phrases that scare people. One of them is, this time is different. George, why is this time so different? Why should we really believe this is happening?
I think the first reason is it's now been announced. It has cross-party support. What I found the most interesting in Merz's statements yesterday is he used the phrase, whatever it takes. But take note, it wasn't used in German, it was in English. And it was also posted on X, on his feed. And this is a very conscious message by the Chancellor in waiting, of wanting to reflect on what Draghi did and sending the same message for Germany. So it does have to go through parliamentary approval. We have a fairly high degree of confidence that it will. And once it does, we are speaking of immense amounts in terms of orders of magnitude. So you discussed earlier on the show the shift around the big infrastructure fund, the potential unlimited defense spending. I would also add they're going to reform the debt brake to allow a greater degree of fiscal spend at the state level, which provides cyclical stimulus as well. So if you add all of these things up, they are going to have a very material economic impact on Germany, and by extension, I think, the whole of Europe.
George, if you have so much conviction, why is your Euro USD target 110? Why isn't it higher?
That's a great question. I would say one step at a time. Every day we're seeing news flow that would usually take years or even decades to potentially feed through. So I would say what we need to argue for an even weaker dollar is for persistent economic weakness in the US. That's going to be a function of what happens from the administration over coming weeks. Do we see a reversal in the tariff policy? So I think there's still a tremendous degree of uncertainty on the US side and how much the recent weakness continues. It is a function of fiscal in the US and tariff. And then there is some execution risk, as we discussed around Europe. But it is the first step, 110, and we're very open-minded in terms of how we think about the outlook.
I think we've got to be open-minded about everything right now, George, including the United States. So let's finish on the US. You mentioned the US side of things. A question we've gone back to repeatedly on this programme ever since the election. Do you see a policy mix that attracts capital to the United States or a policy mix that pushes it away? I asked that question earlier this morning. George, what's your call on that now, and has it changed?
Well, I think it's becoming a bit more ambivalent over the last couple of months. And I would say there's two drivers around that. One just relates to the policy mix itself. It's less about the specifics, and it's almost about the lack of specifics and the uncertainty around the reaction function. Now, if you're putting 20-25% tariffs on half of your imports and you don't know, are they going to be there the next day? Are they going to be removed? That is naturally going to be creating economic uncertainty. And I think we're seeing that materialize, and that is why US risk markets are underperforming. So that's one aspect. The second one is broader, and you could even call it a positive, but to the extent that President Trump is encouraging other countries to build strategic autonomy and is encouraging other countries to spend, all of a sudden, you have an investment thesis potentially for Europe. Now, that's the more positive angle. The more negative angle is the policy uncertainty in the US itself, which I think desperately needs a bit more clarity.
Hey, George, appreciate your time. George Saravelos there of Deutsche Bank, looking for 110 on euro dollar. Not so long ago, maybe a month or two, we were talking about parity and maybe dropping below that level. The last 2 days, Lisa, this is not what people thought would happen. This wasn't in the playbook. Tariffs on, dollar weaker for 3 consecutive sessions.
There was a belief that it would make the U.S. stronger and it would make everybody else weaker. That narrative has shifted. And the most interesting aspect is that the U.S. market is losing faith that tariffs will actually cause the United States economy to get stronger, and instead is projecting more weakness at the same time that you're seeing actual fiscal spending, or the potential for it, in Germany.
This time is different, we're told, out of Europe. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump has called for ending the bipartisan $52 billion semiconductor subsidy program, the CHIPS Act, which spurred over $400 billion in investments from companies like TSMC and Intel. Trump argued that tariffs would achieve the same outcome as the CHIPS Act. An investor group led by BlackRock agreed to buy a controlling stake in some Panama ports. C.K. Hutchinson said that it would receive more than $19 billion from the sale. It's the largest infrastructure deal in BlackRock's history and is a win for President Trump, who had voiced concerns about Chinese influence in the Panama Canal. Elsewhere, China has set an economic growth goal of around 5% for 2025 and a fiscal deficit target of 9.9% to GDP. That is the highest on record. The government plans to boost consumption with a focus on benefiting people's lives and will sell a special bond to fund public spending on infrastructure and other areas. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the president celebrates a bond market rally.
We will defeat inflation, bring down mortgage rates, lower car payments and grocery prices, protect our seniors, and put more money in the pockets of American families. And today, interest rates took a beautiful drop, big, beautiful drop. It's about time.
Bob Michele at JPMorgan Asset Management joins us next from New York. You're watching Bloomberg Surveillance. Equities bouncing back this morning on the prospect of a trade compromise between the United States, Canada and Mexico. Equity futures on the S&P positive by 0.6%, up by 0.75% on the Nasdaq. On a Russell, up by 1 percentage point. Under surveillance this morning, the president celebrates a bond market rally.
We will defeat inflation, bring down mortgage rates, lower car payments and grocery prices, protect our seniors, and put more money in the pockets of American families. And today, interest rates took a beautiful drop, big, beautiful drop. It's about time. And in the near future, I want to do what has not been done in 24 years, balance the federal budget. We're going to balance it.
Here's the latest this morning. The president embracing a big, beautiful drop in interest rates as the White House appears to show more interest in the favourable bond market moves rather than a stumbling equity market. Joining us now to discuss JPMorgan Asset Management's Bob Michele. Bob, good morning.
Good morning.
We've got a lot to get through. We'll get to Europe quickly, but I want to start with the United States. Does it bring you comfort that the White House seems to be more interested in your bond market than the equity market?
It does to some extent. I think bond investors are going to go through a period of discomfort, to borrow a phrase from the president, where probably yields have gotten a little ahead of themselves. So, any kind of backup to the mid fours looks like a good level for us to get in.
So you're not a buyer here?
Not right now.
Are you a buyer of bonds here? Can we bring up the curve? Let's get back to the German curve. 2-year, 10-year, 30-year. Double-digit move we're seeing over in Germany off the back of the prospect of a lot more supply. The 10-year up by 20 basis points. Where do you stand on Europe now?
I think you're looking at steeper curves in Europe. I think you're going to see a lot of issuance. They've thrown fiscal austerity to the side. They've looked at what's going on in China and the U.S., and they want to join the party, and they're going to. I still see the ECB bringing rates down towards 2%, but I think with the amount of supply that's potentially coming in Germany, you're going to drift up towards 3%. I think that's fantastic for bond investors. Again, discomfort near term, but the ability to have a bond market that has yield to it and that's durable, fantastic.
There's a fantastic bond market for investors, and there are fantastic bond markets for traders. A fantastic bond market for investors is one where there's actual coupon, there's actual yield. A fantastic bond for traders, a bond market for traders, is when yields are going down. Is that move over? Is it not any longer a fantastic market for traders?
I think there's potential for yield to go down in the front end of curves. I think central banks, whether it's the ECB or the Fed, are looking for that opportunity to bring yields down a little bit, get closer to what they perceive is neutral. But I think the long end is going to stay about where it is. We're having conversations every day with plan sponsors who want to get into this bond market. They're looking at it as the anchor in the storm. They like the fact they can buy the U.S. aggregate bond market at a yield of close to 5%. They're looking to bring money out of cash and out of risk assets, whether it's privates or equities, and go into the market. Fantastic.
You said this bond market. Are you talking about the United States or developed markets more broadly at a time where we were just talking with a number of guests, Peter Tchir among them, saying maybe Europe is going to draw capital away from the United States?
I think it's all bond markets. I think when you look at what equities have done, they've become lopsided in terms of portfolio allocations. The plans that we're talking to are looking to do some rebalancing, and they're embracing yields where they are. As I said, I met with a plan yesterday. I met with them 5 years ago. The aggregate bond market was yielding 2.25%. They didn't invest. Now today, they've won. Yields have doubled from where they are. They're coming in. And we're hearing that everywhere from every channel around the world.
You said that you think that yields on the long end are probably where they're going to stay, at least in the United States. They're not going to go significantly lower. Do you see them going significantly higher?
No, I think you're stuck in the fours. We're probably a buyer in the mid fours because with another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility, and there may be a period where people run to treasuries and you get down towards 3.90 or 4%. But I think we're going to look back on 2025 and they're going to have spent almost all of their time either side of 4.5%.
A period where we run to treasuries. Let's build on that. Could we be going into a period where we run away from dollar-denominated assets? Certainly not my view, but a view that is out there. People who believe that maybe the policy mix of the United States at the moment pushes capital away. We've heard that a few times already this morning. Where do you stand on that call?
It should be your view, John. I think dollar exceptionalism has ended this week. We've done a lot of work. We've gone back and we've looked at Trump version 1, and we see a similar path where the dollar peaks early a couple months into the term and then tends to come off. We've talked about the dollar being overvalued for a year or so now, and I think now you're looking at fiscal spend in China, you're looking at fiscal spend across Europe, and we're looking at, we didn't talk about Japan, we're looking at close to 1.5% 10-year JGB yields. I don't even remember when I last saw that.
When you say a period of dollar exceptionalism is over, do you mean for the currency specifically, or do you mean the dollar long that we've built up over the last decade in dollar-denominated assets across fixed income and equities alike? Would you go that far?
Yes, I would go that far. I think everyone has talked about how expensive U.S. markets have gotten relative to non-U.S. markets, but nobody wanted to step in front of the steamroller. And now the steamroller's rolling the other way. And I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is. I think that process is underway.
Substantially, if you're correct. Lisa, these are huge changes potentially for financial markets worldwide.
I just wonder how much it reduces some of the flows into U.S. risk markets, and I wonder how much that gives more fuel to what we've already seen, particularly with some of the most consensus bets, which is the technology firms.
All these things we've been asking for such a long time. China needs to do more deficit spending. Headline overnight, you're going to get it. Germany needs to invest more in infrastructure, in defence. Headlines in the last 24 hours, you're going to get it. Deutsche Bank's George Saravelos talked about it about 20 minutes ago, put it perfectly. You cannot overstate the changes we're seeing in the global economy. I know a lot of people sit here in the media every single day and say, big week, I'm guilty of it. Big week coming up, payrolls Friday. Forget payrolls. Forget the data. These are massive policy shifts.
This is the time, and this is something Jim Reed says every morning, that years happen in the period of days. And we've seen that again and again, reshifting expectations. There's a lot to be determined. But my big question is how far does this go in rearranging trade lines? Kind of what Donald Trump wanted. So this is the new world.
Payroll's still important. Friday, 8:30 Eastern time. All right, don't forget payroll. So take that back. Bob Michele at JPMorgan Asset Management. Bob, some big calls. Appreciate your time, sir. Thank you. Up next on the programme, Dan Greenhaus of Solus Alternative Asset Management, Monica Guerra of Morgan Stanley, Congressman French Hill of Arkansas, Ed Yardeni of Yardeni Research. Then later, in about an hour from now, the Commerce Secretary, Howard Lutnick from New York. This is Bloomberg.
We'll have to see how these tariffs as they resonate throughout the economy.
The data in hand tell us it's payback, not a turning point, but it's hard to look forward and say everything's okay.
When you start to see the economic data, kind of wobble a little bit, now you're talking about how firm is that foundation.
The mechanism where these tariffs may have an effect on GDP or in the economy as well as earnings will probably come in faster into the market than it was back in 2018.
Ultimately, we think the Fed's going to cut. We ultimately think the tariffs will probably come back, but be repealed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. So let's start stateside with your scores. Equity futures on the S&P 500 bouncing From a 2-day losing streak on the S&P, we're higher by about 1/3 of 1%. On the Nasdaq, up by 0.5. On a Russell, up by 3/4 of 1%. On a prospect, the potential for a trade compromise between the United States, Canada and Mexico. If you get to the German bond market, no compromise. Over in Germany, the prospect of a fiscal regime shift. Yields are higher by close to 20 basis points on a German 10-year. We're pushing 270. And a change in China. A growth target of 5% and more deficit spending. Some big shifts internationally.
On the surface, it sounds like the United States is at least speaking a tone that they're going to reduce the fiscal overhang, the deficit, while other countries, in particular Germany and China, are talking about increasing their spending at a time where a lot of people have been calling for it. What actually gets done remains to be seen. That said, we're looking at a complete 180 in terms of where the growth is going to come from, where the fiscal impulse is going to come from, and maybe where the capital flows are going to go.
Already had quite a headline in the last 20 minutes or so. It came from Bob Michele, the CIO of JPMorgan Asset Management. The end of dollar dominance. In his words, the end of US exceptionalism. And not just for the currency, but for all those dollar-denominated assets that have performed so well, particularly in the equity market over the past decade.
So how far does this go? And that remains to be seen. I think we all don't know what's going to happen in terms of how many of these plans are actually going to go into effect. But what we're hearing right now are a whole host of policies out of the White House that people don't know how to plan around because we're not sure which ones are going to go on, which ones aren't going to go on. And right now, the market is voting and saying this is probably going to hamper growth, while other countries are saying, let's boost growth, let's boost defense, let's boost our spending.
The strategic anchor for the equity bulls stateside remains the same. In 12 months, when you look back 12 months, you will see a policy mix that is still pro-growth and pro-risk. We can only judge this journey as we go by the economic data that comes in. The sentiment data hasn't been great. The survey data hasn't been great. ISM manufacturing was weak. Later on this morning, 10 a.m. Eastern time, I think, ISM services. Will that confirm the weakness going into payrolls on Friday?
At a time when we're starting to get commentary from a whole host of chief executive officers, Best Buy, we heard from Target, saying that already they're seeing some consumer behavior change on the heels of this uncertainty, and they're saying that they're going to pass along some of the higher prices on the heels of tariffs to their consumers in the coming days. That was the Best Buy CEO. You take a look at this mix, and you wonder, maybe we're getting too far with this weakness story. It's only been 6 weeks. It's hard to remember that, and I keep reminding myself. That said, going forward, it turns all of the consensus trades, you've mentioned this before, on their head at a time when there were some very heavy longs that are getting upended.
Those consensus trades have been beaten up all right in the first few months of 2025. Equity futures this morning positive by 0.4%. Coming up, Dan Greenhaus of Solus Alternative Asset Management on a wild day for stocks. Monica Guerra of Morgan Stanley on President Trump's joint address to Congress. And Congressman French Hill as Trump warns of economic discomfort from tariffs. We begin this hour with stocks looking to snap a 2-day losing streak as Secretary Lutnick hints at a possible tariff compromise. Dan Greenhaus of Solus Alternative Asset Management writing, I'm still optimistic in general, but have felt and still feel we're in a holding pattern for risk assets until at least the Fed meeting on March 19th, but perhaps even longer. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
What's special about March 19th? Why the Fed meeting?
Well, I think my point back at the when the inflation data had come out, that we were unsure of how the Fed would respond to this. This was before a lot of the tariff stuff had really exploded. And I thought, well, listen, we've had a really good run in asset prices here, both equity and credit, among others. And so it's not out of the realm of possibility that we digest this and get some guidance from the Fed and how they think about the inflation backdrop. And then, of course, the situation has been compounded in the last couple of days by the tariff story.
We mentioned the strategic anchor for bulls here in the United States, and that's the policy mix of the overall platform, not just trade, but the complete picture is still pro-growth, still pro-risk. Has that changed?
No, I mean, the problem always was and remains that the positive parts of the incoming administration are going to take longer to implement than the more deleterious policies. So out of the gate, you have some immigration curbs, if that's a problem for you, some tariffs, if that's a problem for you, and the deregulation, if you will, or the more permissive M&A environment that everyone's hoping for, the extension of the tax cuts or perhaps some additional tax cuts, tax on tips, et cetera. That's going to take many, many months, if not even longer, to work out. And so what the market is wrestling with now, again, on the heels of a really terrific rally, are some of those more deleterious policy outcomes that are resulting in something of a correction in stocks, which we're experiencing in credit as well. And I don't think it's super unhealthy. But with that said, those other options or those other policies are still coming down the pike. The economy is still holding up fairly well, although obviously Q1 is looking worse by the day. So I think you still have to remain optimistic in the larger sense while understanding we're undergoing something of a correction now, which is not unusual.
You came in this morning. I'm going to tip your hand.
Sure.
You said today's going to be easy. You're going to ask me questions, and I'm going to say, I don't know, because that's pretty much what everybody's doing.
You took my joke.
Okay, well, I took your joke because I wanted to build on it and ask you, doesn't that have an effect? Doesn't that have a ramification, this level of uncertainty that means that all the companies that are planning M&A don't know what kind of structure they're going to be looking at when they actually go to transact those deals?
Well, yes and no on the M&A front. I mean, M&A transactions are long-lived deal-making processes. So I think a lot of people are going to look through this and say, okay, where do we expect the old Warren Buffett line, I'm betting on America type of. So the M&A story, I think, is going to be there. Obviously, we have to get a handle on how permissive relative to the previous administration, the current administration is. And as I always remind everybody, J.D. Vance did say Lena Khan was his favorite. And I think the idea that there was going to be unfettered M&A activity allowed was probably always a little optimistic. But that said, in the immediate term, of course, what's happening right now chills investment, chills optimistic risk-taking. And you see this playing out in equity and credit. Again, it comes on the heels of a terrific rally for the third or fourth time, because I think it's important. If something like this happens at the bottom of 09, it's different than if it happens now.
You're saying the pro-growth policies are going to come down the pike. Which pro-growth policies are you talking about at a time where they're trying to pass a budget that extends the tax cuts, but doesn't really have any provisions in it for some of what Donald Trump talked about last night, whether it was no tax on tips, no tax on Social Security, and no tax on a host of other different issues?
So, listen, I think this is a really complicated conversation. In the immediate, listen, if you're going to balance the budget in a year, that's not pro-growth. Whatever one feels about the level of federal spending or the worthiness of federal spending, removing that much fiscal expenditures from the economy in a short term is not going to be pro-growth. It might be down the road, but it's not going to be in the short term. What I'm looking forward to is that more permissive risk-taking environment, is the extension of the tax cuts so that uncertainty gets taken off the table. Perhaps you get some other fiscal expenditures as well. The immediate budget deficit is going to expand. All of that together with the pro-America attitude of the administration, which matters for a lot of risk-taking, both among individual investors and companies, is being overshadowed right now by the uncertainty around the tariff debate. And as we saw with Howard Lutnick, Commerce Secretary Lutnick last night, that might, an hour from now, might not be the case anymore. So it's not that I'm looking forward to no tax on tips revolutionizing the tax landscape or or putting someone in place at DOJ or FTC that's going to be incredibly different. It's the totality of the attitude of the incoming administration, both in terms of how it presents itself and its policies that it's putting in place, that on balance is going to be more optimistic and more pro-America and risk-taking than the previous administration. And that's not to say that automatically equals higher stock prices or lower credit spreads, but on balance, it equals higher stock prices and lower credit spreads. And as long as the economy continues to hold up, I think that's the type of environment in which you want to be positive on risk assets.
Well, that's the key part, as long as the economy continues to hold up. So I sit in a similar seat. I want the president to succeed. I think everyone should want the president to succeed, regardless of who the president is and what political party they bat for. The thing I worry about, and I can share it, and I'm happy to, sentiment was sky high into 25. And we all said repeatedly, I want to see that confidence turn into hiring, into investment decisions. My fear now is that by the time we get to tax policy, something bad's happened in the economy. So what are we looking at the moment? We're looking at the cumulative impact of persistent uncertainty around the trade story.
Yep.
You can't say it's 25% on our neighbours one day, come out a couple of hours later and say we might be dropping them. I've got no idea what the Commerce Secretary says in 40, 50 minutes' time on this programme. I look forward to hearing what he's got to say. There is some damage done by that. Every time I hear from a CEO at the moment, particularly from the banks, they say wait and see. We're in wait and see mode. Wait and see mode, if you're choosing to do nothing, you're choosing to do something, and that's nothing. As opposed to hiring people, investing, getting deals done. I just wonder where we'll be by the time we get to the summer. By the time we get to the end of the year, and we're talking about dropping taxes, maybe the corporate tax rate down to 15%. The soft data's already softer.
Yep.
Can't debate that. I need to work out from you and your opinion whether you think the hard data's going to weaken as well between now and them? Because that unleashes some very different forces.
Of course. And listen, the soft data, the survey data, has weakened repeatedly over the last couple of years, even before COVID, in a way the hard data has not.
We've seen head fakes before.
For sure. Last summer, when the S&P fell, call it 10% or something like that, the BOJ was hiking rates. There was worry about a recession. Jobs numbers, that was the first time they started dipping into double digits. You had a meaningful sell-off at the end of 23. I think it was maybe more than 10% of the S&P in that time for similar reasons, not the BOJ hiking, but economic worries. And we're going through one of those now. Do I think the hard data is going to roll over? The answer is no. Now, Anna Wong, Bloomberg economist, wrote about the risk to the jobs report on Friday owing to the lack of hiring and layoffs in the federal level. What I don't know, and we're going to find out, is if that number, and she posits that it's within her confidence interval that the number could be negative, and I've seen one or two other people on the street speculate as well, if you have a bad number on Friday, but it's 40,000, but the private sector added 90,000 or 120, how does the market deal with that? Because there are many people who are going to say, well, we're laying off unproductive federal workers. That's going to reduce the budget deficit. Positive for yields, which have already come down. That's good for risk assets. I don't know the degree to which the market is going to weigh job losses in the federal level, which appears to be something that we're going to find out on Friday, if not over the next few months.
That could be an important test, Lisa, for this market in the coming weeks and months.
Yeah, how much people look at the details of some of these labor market reports to really understand exactly what's going on. I'm just thinking, as you were talking, and something that we're grappling with, can you put this sort of sequential story on hold as sort of, okay, we'll do all the bad stuff up front and then the good stuff at the end, and really expect the stuff up front to have no consequence when it isn't necessarily that the plan is coming out, it's the uncertainty around the plan. And I think that that's going to be a continually theme.
It's journey versus destination. I think the destination still could be a very good one. Just the journey has started, and we can only look at the data so far to guide us, and the data so far hasn't been phenomenal.
Yeah, the journey, though, this is sort of the classic life story, right? The journey can change you. And so you might not be the same person when you end up at that destination. And so there is a question of how it sort of leaves its mark. And I think that is what we're all grappling with.
Dan's got to go. We'll continue the therapy session. Commercial break.
Dan does not have to go. Dan wants to talk about oil prices.
Do you want a final word on crude?
You just have to. Oil was just $80. It's now under $7.
Big drop. Rates are down too.
The rates are down. The inflation story is not just tariffs on goods. The first administration, we saw goods prices went up. Overall inflation sort of stagnated around 2%. It's a different environment now for sure, but oil prices don't get enough attention in this conversation.
They're getting attention right now. Crude's down, rates are down. You don't think it's just about economic growth?
Well, it's part about economic growth, but it's also OPEC is unwinding some of their supply constraints. And listen, the president has said, I want lower oil prices. And for people who believe in this president and his ability to get deals done, so far he's $10 in. I don't think he's going to be happy until it's 50.
The Treasury Secretary sat in your seat and said basically the same thing. We need to bring energy prices down, need to get inflation lower, need to get interest rates down, bond yields lower, and then we can talk about doing a lot more on the fiscal side of things.
And I always say the first step to being Treasury Secretary is sitting in the Treasury Secretary's seat. So we're on the way, step one.
Yeah, well, we'll see. I mean, these are the ideas behind can you generate growth and how do you create a more fiscally viable structure. Is this by design? This is what they're targeting, lower yields and lower oil prices, and that's what they're getting.
They're certainly celebrating it. Dan Greenhaus of Solus Alternative Asset Management. Dan, thank you.
Thank you,
Good to see you. Thank you, sir.
Always a pleasure.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Breaking moments ago from the Financial Times, the U.S. has cut off intelligence sharing with Kyiv. Two officials confirmed with the FT that Washington had frozen the channels with Ukraine, a move that could hamper Ukraine's ability to identify and strike Russian military targets. It follows President Trump's Monday decision to suspend military aid to Ukraine. Democratic Congressman Al Green of Texas was removed from the House chamber during President Trump's joint address to Congress last night. Green shouted and shook his cane in protest. Meanwhile, Senator Alyssa Slotkin of Michigan presented the Dems' response.
President Trump is trying to deliver an unprecedented giveaway to his billionaire friends. He's on the hunt to find trillions of dollars to pass along to the wealthiest in America. And to do that, he's going to make you pay in every part of your life.
Slotkin went on to argue that Trump's tariffs will hurt U.S. manufacturing, farming, raise costs, and potentially lead to a recession. Canadian Prime Minister Justin Trudeau says that President Trump's tariffs are an attempt to destroy Canada's economy so he can annex the country. Trudeau said that his government will file a dispute with the World Trade Organization and the free trade agreement between the U.S., Mexico, and Canada. Canada earlier hit back with levies targeting about $21 billion worth of U.S. goods, which it says will be expanded if U.S. tariffs stay in place. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Trump trade agenda.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. The tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
We'll talk about that disturbance in just a moment with Monica Guerra of Morgan Stanley from New York City this morning. Good morning. So we've got a bounce this morning. We're up by a third of 1%. In about 50 minutes from now, don't miss this, a conversation with the Commerce Secretary, Howard Lutnick, about trade and the potential for a compromise between the United States, Canada and Mexico. Off the back of that potential, equity futures positive by a quarter of 1% on the S&P 500. Bond yields a little bit lower. We're down 2 basis points, the 10-year 4.22. Under surveillance this morning, the Trump trade agenda.
For every one new regulation, 10 old regulations must be eliminated. The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. And I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
So here's the latest this morning. President Donald Trump reiterating his America First agenda in his joint address to Congress. Trump pushing for tax cuts and eliminating the CHIPS Act while acknowledging that tariffs will bring some economic disturbance. Monica Guerra of Morgan Stanley writing the market could be undercounting the long-term impact of tariffs because of policy uncertainty. Monica joins us now for more. Monica, good morning.
Good morning.
I'm so pleased you went there because I think this is so important. Whether the tariffs are 25, 20, 15 or 10, I think the business community just wants to know and have certainty and start to plan for the next year, several years. That uncertainty, that volatility of the policy itself, how much damage could we see off the back of that?
The policy itself, I think, could have significant implications depending on the different industries that it's impacting. When we're thinking about the policy uncertainty piece, not essentially undercounting potential impacts, it's what happens next. Now with Mexico and Canada, we spoke last week. We thought that something like this might happen, right? That the tariffs could be implemented. They could be renegotiated. You have USMCA potentially pulled forward into 2025. That situation, our relationship with our neighbors, is incredibly dynamic. It's what happens in April. And I think that staying on top of potential tariff risk is important.
There is a question about who President Trump is speaking to, because markets had just expected heading into this year that he would be catering to them on some level, that he'd be looking for market approval. It seems like that's not the case, with a little bit of disturbance being just fine. Do we have a sense of where President Trump is looking to sort of get that approval?
So the little bit of disturbance piece, I think, is key, because the sell-off we saw was, just in the, the range of 2.5 on the day on the second, right, when the tariffs were implemented. You saw, the biggest hits, right, to tech and energy, given the types of tariffs that were being, proposed. Now, what's important here is that that's not this big market downturn. If you had a greater correction than that was prolonged, that I think would get the president's attention. But a point in time, momentary response is expected, and something that I think, he is saying we can all live with, that markets are rebounding. They're looking to the potential of his negotiating tactics long term.
You aren't seeing, though, deals being announced. You actually saw M&A volumes fall pretty significantly in February. We've talked to a number of executives saying we just don't have the certainty. And to John's point, that uncertainty drags on growth, and you're starting to see that in some of the data. In your conversations with people in Washington, D.C., is President Trump and his cabinet concerned about that level of uncertainty and some of the soft data rolling over?
No, I don't think they're concerned. Now, what we've seen as far as their strategy in Trump 1.0, it was the growth policies first and then tariffs second. This is the reverse. They're intentionally doing this. They're coming in at a point of extreme geopolitical tension and conflict, so they're looking to address that, essentially reinforce the America First agenda, and then hoping that off the back of that, the growth policies pick up. So when you're thinking about, this is where budget and tax come in, that if you get the cuts, if you get additional cuts to corporates, they're hoping that that's going to create tailwinds through 2026, because that's when they go into effect. So 2025 is a restaging, resetting, resizing year. It's going to be choppy. This is something we talk to our clients about regularly, that this is a bumpy year, that you have to see through it. And that's what I think the Trump administration is, they're looking at too, is what happens in 2026 and then legacy going forward.
Lisa mentioned this earlier. I think it's an important point regarding taxes. 2017, we were talking about tax cuts. 2025 into 26, we're talking about the extension of tax cuts. How different is that? And will we get additional cuts beyond just the extension of what we did back in 17, 18?
So they are different. If you're looking at it from a budgeting perspective, you have to start from where we are now. What would be the impact long term? So if you extend the tax cuts as is, that would add $4 trillion just off the bat to the deficit. Now, if you get additional cuts, it's likely to be, to Social Security, to, no tax on tips, those types of give backs to the individual. But more importantly, on the corporate side, Trump has said he wants corporate income tax top line as low as 15%. So that is, significantly stimulative in the long run when you're thinking about corporate America.
He wants 15 with a U.S. production element attached to it.
Yes.
Do we really understand what that's going to look like and how it works?
I don't, especially because I think that there is a component here that people are missing, is that you have to pay for those tax cuts somehow. Tariffs is one way that they're looking to do that, right, through that external revenue service, passing through funding, right, through an accounting adjustment. The other thing that people aren't looking at is the potential for increased corporate taxes on foreign revenues. So this is something they did in 2017. It's I would say an easy, low-hanging fruit if they're looking to raise taxes, because it speaks to not only trying to re-incentivize businesses to bring their production, manufacturing, sales home, right? But it also helps offset any top-line corporate income tax reduction.
And you need the tax picture to really fully understand the overall effort alongside the trade effort.
So if, for example, some of the auto manufacturers had to pay 25% tax on parts from Mexico and Canada, it would be offset with a 15% tax rate, top-line tax rate that would come later on. It's in theory.
In theory.
Yeah.
That's how it all comes together.
Right, but then the sequencing does matter.
Monica.
Sequencing matters, yes.
We've got to go. I appreciate your time, as always. Thank you. Monica Guerra there of Morgan Stanley. Up next, Congressman French Hill, as President Trump warns of economic discomfort. Still ahead. "30 minutes from now, Must Watch." Live on Bloomberg Surveillance, Howard Lutnick, the Commerce Secretary, on the potential for a compromise between the United States, Canada and Mexico. And that potential, according to the Commerce Secretary himself, unlocking some gains in this equity market. Equity futures bouncing this morning, 2 hours away from the cash open, higher by a third of 1% on the S&P, on the Nasdaq up by 0.5, on the Russell up by 0.8. With a few hours until that cash open, let's get some morning movers for you. Here's Manus Cranny with more. Morning, Manus.
Jonathan, that's manifest in all the order names, but I picked off Stellantis. Of course, Commerce Secretary said it's not a pause. Well, what is the recalibration? That's going to be the critical thing, because 4% of U.S. autos production is now tariffed at 25%. Stellantis garners even more support from the European Union relaxing, you got it, Jonathan, CO2 emissions. You've touched on it several times, stepping back from some of the bars that they have set. Let's see what Commerce Secretary has got to say, because profits will be under pressure. Tesla Politics and production. Let's deal with the production. Sales in Germany fall 76% in February. EV registrations rise 31% in Europe. In the first 2 months of the year, down 71%. So this is about recalibrating production of Model Y and at the same time the SUV. But I'll leave you with a kicker. In the UK, their sales rise by 11%. So it's not all political. CrowdStrike. You might have had an interruption in your flight last year. You may remember the securities software firm were behind it. That cost $60 million in 2024. They told us in the latest quarter, that's another $21 million. CEO, you gotta love it. Everyone loves a comeback story. Not at the moment. John.
That story feels like a decade ago. A lot's changed since then. Manus Cranny, thank you, sir. Some of the movers to watch going into the opening bell on our radar this morning. Commerce Secretary Howard Lutnick hinting at a possible tariff compromise with Canada and Mexico that could come as soon as today, saying tariffs would not be fully rolled back, but will land, quote, somewhere in the middle.
This is where people are waiting for, and this is the hope that we're seeing priced into markets. It is curious that last night, President Trump, did not talk about the idea of rolling back tariffs. In fact, he just doubled down and talked about how tariffs are going to make the United States rich again. So I'm curious about how this goes forward at a time where there's a real fissure between some of the allies in the United States, and a lot of people are waiting for April 2nd to really be the reassessment date when retaliatory tariffs go into effect.
The great irony of that is pushing the allies to do things that are good for them. We've talked a lot about Europe and Germany potentially spending a whole lot more. China overnight setting an economic goal of about 5% for growth for 2025. The country also announcing its highest fiscal deficit target in over 3 decades. Those kind of moves were the kind of moves that people have been talking about for years and hoping these countries, China and Germany, would go through with.
With China, it was interesting because they had their annual confab of leaders, and they came out talking about trying to boost consumption among just the rank and file Chinese residents. That was interesting, a notable shift from previous iterations where they didn't want to really give direct subsidies to individuals. Europe is really the big story this morning to me. This is probably the biggest shift I could possibly imagine. The always fiscally restrained Germany coming out. And let's just emphasize, it isn't just $500 billion, 500 billion euros for infrastructure spending. It is an unlimited checkbook for military spending, defense spending. This is whatever it takes when it comes to beefing up exactly what President Trump wanted them to beef up.
If they can get it through Parliament, and a lot of people in Europe, experts on this, tell us they can, and we'll see. But to your point, President Trump wanted the Germans to spend more on defense. They're spending more on defense. Secretary Bessent wanted the Chinese to rebalance their economy. Based on the moves last night, they're pushing to rebalance their economy. We're moving in the right direction.
A lot of people in markets seem to be suggesting, be careful what you wish for. And I think that there is this issue. If you start to see capital being sucked out of the United States, will it be a positive with respect to being able to rebuild industries in the United States? Or will it leave a hole in asset prices and potentially some of the investments that were also part of the plan? And that part of the plan, we still need to see.
Yeah, this won't address everything. In China, there's still big problems with imbalances, and in Europe too. You're not going to shift European culture overnight, even with a plan that big from Germany, but this is the first step. It's a start.
Which is the reason why people are reshifting their entire perspective. The idea that George Saravelos said overnight his view changed on the euro. He was bullish now on the euro. And it just sort of was a matter of how far he could take it.
He's got no choice. It's hard to be bearish right now. You've got a 23 basis point move on a 10-year yield over in Germany this morning. We're up by 13 at the front end of the curve, and a euro stronger by 0.75%, around 107. Elsewhere, BlackRock striking a $19 billion deal to place Panama Canal ports under American control. President Trump taking a victory lap in his joint address to Congress last night.
To further enhance our national security, my administration will be reclaiming the Panama Canal, and we've already started doing it. Just today, a large American company announced they are buying both ports around the Panama Canal and lots of other things having to do with the Panama Canal and a couple of other canals.
There's a fantastic story on the Bloomberg terminal, by the way, that I suggest you all take a look at. It's on BlackRock and on this deal. It's available on Bloomberg.com as well. Donald Trump promised on day one to seize the Panama Canal. We're taking it back, the US president declared in his inaugural address. Within weeks, Wall Street billionaire Larry Fink was on the line with the White House.
And the headline of that story is that BlackRock's Fink used a direct line to Trump in the Panama Canal deal. And that, to me, highlights how people are thinking about this administration. They're listening to what he says, and they're saying, I have a deal for you too. And I can figure out how to put $19 billion into this and then get United States ownership over a key trading infrastructure piece that the United States helped build. A real question of what else is to follow. And this is something that's interesting. These are all of the ways that people are hearing Donald Trump's speeches very differently. If they're in the private sector and they're saying, look, what can we do to take on some of those projects? So we can expect more of that.
The president had a lot to say, a 100-minute address. He also defended his tariff plan, saying America may go through a, quote, little disturbance, but tariffs are worth the economic pain. Annmarie joins us now from Washington for more. Annmarie, over to you.
Good morning, Jonathan. That's right. The president really doubling down on his tariff agenda and plan, even though he said that we could see a little bit of economic disturbance when it comes to those, really alluding to the financial markets and potentially what we're hearing from some corporate executives. And for that conversation, I'm very pleased to say we're now joined by Congressman French Hill of Arkansas, also chairman of the Financial Services Committee. Congressman, thank you so much for joining us this morning. I saw you very late last night leaving the chamber, so thank you for getting up early for us. Trump sounded committed to his plan last night when it comes to tariffs. One of your biggest employers in the state of Arkansas is Walmart, and the CFO said a couple of weeks ago that it's not going to be completely immune when it comes to tariffs. So what are you telling businesses in corporate America that are concerned with his trade policies?
Well, Annmarie, it's good to be with you. Well, as I've said on this show for many, many years, I think across the board tariffs in a sustained way can lead to higher prices, and they may or may not lead to measurable increases in output here. I think that's what we've seen since 2017 on the steel and aluminum tariffs that we've had imposed by the Trump administration and left in place by the Biden administration. A modest increase in production and but no real impact in major employment. In fact, in some instances, higher prices if you were buying a washing machine, for example. So, bottom line is, I think the best use of tariffs are exactly as I hope I hear from my friend Howard Lutnick in a few minutes, that they're used for a negotiating tool to get better trade arrangements, open markets with countries. And as it relates to the USMCA, Annmarie, it's so important. That's about 30% of Arkansas output goes to Mexico or Canada. I believe the best way to approach this is to simply reopen the USMCA and have Canada, Mexico, and the United States continue to look at that agreement and try to improve it. For example, if you're concerned about transshipment of Chinese activity in Mexico, why not talk about the rules of origin in Canada, the U.S., and Mexico in terms of foreign components? Talk about, again, the share of North American manufacturing component. That's the way I think it's best to handle a trade between the two countries in our existing agreement, because across the board tariffs, as you well know, raise the cost of every automobile in the United States.
Commerce Secretary Lutnick, as you alluded to, said yesterday that there could potentially be a compromise. We'll hear from the president today. Are you hoping to hear about exemptions or carve-outs, or actually lowering the 25% rate?
Well, I would leave that to Howard's strong negotiating skills. I'm not going to try to out-negotiate either Trump or Lutnick when it comes to representing the United States. I just think that it's smart to consider all the downstream effects from tariffs and have clear objectives of what you're obtaining. You want border security, you want to remove fentanyl, you want to stop transshipment of dumped steel or aluminum from another country through Mexico or Canada into the United States. Those are all worthy objectives, but I think they can be handled through negotiation.
Trump yesterday said at the speech yesterday that they can deal with a little disturbance, alluding to the stock market pullback and potentially the concern about how this could mean passing on prices, higher prices to consumers. Do you think the president still cares about the Dow Jones Industrial Average? He didn't mention equities at all last night, but he did mention rates. Is he squarely focused now only on the 10-year yield?
I think the president's focused on bringing broad manufacturing back to the United States. And I think the United States is the single best location for foreign direct investment in the world, for all the reasons that your panel just talked about with Jonathan. Europe is not surging. Europe is slumping. And I'm glad to see that actions taken by the U.S. are encouraging maybe a change economically and militarily in Europe. I think that's terrific. And Xi Jinping's effort to, quote, take care of his economy last year was a total flop because he's not addressing consumption or long-term savings or pension plans or internal use in China. So both those economies are not where you want to invest. And where people want to invest is here in the United States with low tax rates, declining regulatory burdens, the stable dollar, our rule of law. And so I think President Trump's focused on making America great again through that process. And I think that's what he's focused on.
Congressman, I'm glad you brought up investments, because yesterday Trump called for the end of the bipartisan $52 billion chip subsidy program. Now, I know you didn't vote for it, but more than a dozen of your Republican House colleagues did. If companies already signed up for that program and decided to expend capital in the United States, should those contracts be able to go through?
I think if the money's obligated and the people are actually designing and implementing a facility here, then that's probably something that the United States should honor. It's a law signed into law by President Biden. I did not vote for it. I don't believe in industrial policy. I don't think we should be subsidizing directly with taxpayer money, using mandatory spending in the federal treasury to encourage a chip plant to come here and build when they were already coming in here to build. So that's why I didn't support that particular proposal.
I want to end on a markup you have today that's become a bit contentious in terms of politics when it comes to the overdraft rules that we saw under the Biden administration. Now, if your bill goes through, when you look at banks and their overdraft rules, they won't decrease. But there's a chance that with the Biden administration's rule that's in place, you can actually see some of those bank overdrafts decrease. You're pushing for the status quo. At a time when Americans are dealing with higher consumer prices, why not allow this rule to go through?
Well, Rohit Chopra, the director of the CFPB, is essentially the poster child of why you see the Chevron deference being rolled back. He violated the statutory authority of the CFPB in instituting this rule in the midnight rules that he passed between the election and the inauguration of President Trump. I don't support federal price controls through a mandate like this. And let's look at the reality. I spent a great deal of my business career dealing with the poorest citizens in Arkansas and the Mississippi Delta and providing banking services to them. I know how important competitive overdraft services are to them. Tim Scott grew up poor as the chairman, and now the chairman of the Senate Banking Committee. He knows the value of the overdraft protection privilege for families. When you mandate this kind of a price cap, you're going to deny deposit services and overdraft privilege services to millions of low-income American families. That's why the CFPB rule is wrong. I want competition to handle that as it is today. Every customer I had at my company in the Mississippi Delta was a smart consumer of how to balance their capital needs and income needs for their family every month. And what Rohit Chopra does is take that privilege away from millions of people. And to your point about competition, what's going on, many big banks, Citibank, Capital One, they don't even charge for overdraft protection, and that's through competition, and that's what I think is the way to go. You force people out of overdraft, like Chopra would like to do. You send low-income families to the online and payday lending market, which I don't think is in their interest.
Congressman, thank you so much for your time this morning.
You bet,
really
Annmarie.
appreciate it.
Great to be with you. Thanks.
Jonathan, that was, of course, French Hill, Congressman from Arkansas, also the chairman of the Financial Services Committee. At the top of that conversation, what I took away is he's expecting what he calls his friend, Howard Lutnick, a great deal maker, to come out with something today when it comes to Mexico and Canada.
Well, Congressman Hill's been a good friend of this programme. Looking forward to catching up with his friend in about 15 minutes' time, live on Bloomberg Surveillance. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A Ukrainian official has told Bloomberg that the country is still receiving U.S. intelligence. That follows a report from the Financial Times that the U.S. had cut off intelligence sharing with Kyiv. If the channels are indeed frozen with Ukraine, it could hamper their ability to identify and strike Russian military targets. New York Fed President John Williams said that he anticipates that Trump's tariffs will contribute to inflation. Williams spoke yesterday at the Bloomberg Invest Conference in New York.
Based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year.
Williams went on to say that monetary policy is in a good place and that he doesn't see the need to change borrowing costs right away. Disney is cutting about 200 jobs across its ABC and entertainment TV networks. An internal memo seen by Bloomberg outlines cuts that mostly impact the ABC News division in New York, with production teams for ABC News Studios, 2020, and Nightline set to be consolidated. In its earnings last month, Disney's broadcast and cable TV business saw a drop in revenue and profit. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the Trump put.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them.
Up next on the program, Ed Yardeni of Yardeni Research. Then later, at the top of the hour, 8 a.m. Eastern Time, less than 15 minutes away, the Commerce Secretary, Howard Lutnick from New York. You're watching Bloomberg TV. In the next hour on this program, a conversation with the Commerce Secretary, Howard Lutnick, just moments away. Look out for that. A conversation following yesterday's comments from this individual that maybe we could have a compromise between the United States, Mexico and Canada. The Commerce Secretary, Howard Lutnick, just moments away. Equity futures off the back of that potential compromise with a little bounce, up by 1/3% on the S&P. On the Nasdaq, up by 0.5. Under surveillance this morning, the Trump put.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more, and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
So here's the latest this morning. Global markets eyeing signals of tariff relief after US Commerce Secretary Howard Lutnick suggested there might be a trade compromise as soon as today. Ed Yardeni of Yardeni Research writes, we're not changing the 55% assigned to our base case roaring 2020 scenario, but we now see less chance of a stock market meltdown scenario and higher odds of a recession and bear market. Ed joins us now for more. So Ed, let's start there. Potential changes for you, and I stress potential. What underpins them?
Well, look, this administration changes its mind quite often, puts out some pretty extreme positions, and then waits to see what the other side will come back with. And that's what we're seeing right now with regards to the tariffs. The Treasury Secretary a few days ago said that he would welcome a situation where Canada, Mexico, and the United States had the same tariffs on China, and that would sort of create a fortress North America alliance, trade alliance versus Chinese imports. So there's, this is a very fluid situation, and as a result, my forecasts are rather fluid. But I think we'll get through this, and I think at the end of the day, we'll probably see lower tariff rates rather than higher tariff rates. But I'm a little confused about what this administration really wants. Does the president want all manufacturing in Canada and Mexico to come to the United States? If that's the case, that's a completely different and more radical view than just lowering tariffs.
Ed, you were the one who coined the Roaring 20s. You came out with projections that a lot of people dismissed as overly ambitious and overly bullish on equities, and you were right. You cite in this sort of slight, subtle shift that you had this morning that it is in reaction to the volatile nature of policymaking under President Donald Trump, not necessarily the policies themselves. How long can there be volatility in policymaking before there is a weight on the economic activity in the United States?
That's a great question. I don't really know, but my hunch is that we'll kind of come to settle down. We in the markets will come to recognize that this volatility is here to stay, and we'll start to tune it out. And it all depends on how the next 6 months go. If the extreme positions wind up just being negotiating positions and deals are done, we're seeing that we're maybe back to the table with Ukraine, maybe back to the table with Canada and Mexico. You'll have your interview with Lutnick shortly. We'll see how it is. But as a forecaster, I kind of have to go. It's kind of like riding a bucking bull, right? I still think we're in a bull market, but it's not a leisurely stroll with a bull anymore. It's the bull's trying to throw us off. But I would stay on it because I think at the end of the day, the U.S. economy is going to prove resilient. As you know, there's a lot of fears that we're already falling into recession, but a lot of those indicators for January, I think, were misleading, and I think we're going to see that the economy is actually pretty strong.
Putting aside just the questions about the economy, which are big, and we shall get more data, and a lot of people are very focused on them, how much are you shifting your view about the United States as being the best place to invest at a time where suddenly we're seeing massive sea changes in the likes of Germany, suddenly expanding their spending?
Well, I think that's a great point, and I think as in your previous interview, which was great with Representative French Hill, he made the point that America's stances these days are forcing Germany to spend more on defense and loosen up their deficit brake. And they're forcing the Chinese government to spend more to stimulate the consumer. So this is actually all adding up to a pretty positive outlook for the global economy, notwithstanding that we're in a trade war. And if that's the case, then you're making a very good point that there are opportunities overseas, but they've been recognized. The Chinese markets already had a big move up, and the German markets had a big move up. But there's probably more to come.
Getting a big move up in Germany again this morning. Ed, we've got to leave it there. Ed Yardeni there of Yardeni Research on global markets. The move up in Germany, a 3% move today on the equity benchmark in Frankfurt, Germany, the DAX. And if you check out the bond market, we're talking about double-digit moves right the way through the curve. 20 basis point moves on a 10-year security over in Germany.
It raises a real question for the ECB tomorrow. How do they respond to this when they're expected to cut rates by 25 basis points? How long can they keep doing that if suddenly you have a fiscal injection?
We've had some big calls, haven't we, already this morning? We've got another hour to go. Bob Michael, the CEO of fixed income at JPMorgan, about 60 minutes ago, saying it's the end of dollar dominance, the end of US exceptionalism.
And having a very different tone about how bullish he is on long-term yields, saying we're probably range-bound as we reset our expectations for fiscal spending.
There's a long list of very unsuccessful people who have bet against America over the last decade.
I would agree.
Let's see if that turns out well this time. Coming up, Commerce Secretary Howard Lutnick, Chuck Grom of Gordon Haskett, David Mericle of Goldman Sachs, Mike Schumacher of Wells Fargo. The third hour of Bloomberg Surveillance up next.
When you think about all the catalysts, the risk is not quite balanced versus the reward at this point.
The market's been fighting off kind of recession talk now for 2 or 3 years.
Tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
The strategists are getting negative. The traders, the investors are nervous about what this means.
If sustained, these types of tariffs could shave minimally 0.7 off of growth for the year, maybe even a full percentage point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and this hour you've got some economic data. About 15 minutes from now, we get the ADP jobs data. Look out for that later on this morning. ISM services. Why is that data point so important? Because earlier this week, ISM manufacturing beneath the headline number was really soft. New orders, not good. Employment in contraction. Prices paid creeping higher. That is going to be one to watch a little bit later. In the equity market right now, equity futures shaping up as follows on the S&P 500. On the NASDAQ, on a Russell. A bounce this morning. On the S&P up by 0.2%. On the NASDAQ up by 4%. The why? The potential for a compromise, Lisa, on trade between the United States, Mexico and Canada.
There was a fear yesterday that maybe this was it, that 25% would stick in terms of the tariff terms for Mexico and Canada, and this was just the beginning. If there is a relief valve, that will give markets confidence again that they haven't had in the past couple of trading sessions.
So we begin this hour with markets bouncing as the Trump administration signals a deal could be reached to relieve tariffs on Mexico and Canada. Joining us now is the man behind the negotiations, the 41st United States Secretary of Commerce, Howard Lutnick. Mr. Secretary, before we get going, a warm congratulations from the team here at Bloomberg Surveillance on your confirmation.
Thanks so much. And wasn't last night's speech amazing? I could have been more proud of President Trump.
We'll get into the niceties on that in just a moment. Let's kick it off, sir, with a question about your comments yesterday, when you suggested that maybe there could be a compromise on trade between the United States, Mexico and Canada, and maybe we'd hear more about that today. Has the president confirmed that? Is that still the plan?
Well, I think what happened is you have the trade ministers and all the people from Canada really working hard with our Homeland Security people. Remember, this is not a trade war. This is a drug war. We've got fentanyl still pouring into the country, and it's got to stop. So what's happened is they're showing us even more ways to try to stop the flow of fentanyl. And if they can stop the flow of fentanyl, the president is open-minded. There are going to be tariffs, let's be clear. But what he is thinking about is which sections of the market that can maybe he'll consider giving them relief until we get to, of course, April 2nd. But I don't want anybody to forget, April 2nd is the day that we announce our reciprocal tariffs around the world. And so April 2nd is coming, but this is about fentanyl this month.
Got that. Just want additional clarity. Just to be very clear on this. Yesterday when you said, I think the president's going to figure out, you do more and I'll meet you in the middle. We're probably going to announce that tomorrow, as in today. Can we no longer expect that announcement?
No, I didn't say that. I said the president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle. So not 100% of all products and not none. Somewhere in the middle, because I think Mexico and Canada are trying their best. And let's see where we end up. So I do think somewhere in the middle is a likely outcome.
When you say somewhere in the middle, do you mean somewhere in the middle on tariffs, as in somewhere between 0 and 25? Or do you mean that certain groups, certain industries will just get a carve-out? And would that carve-out be, say, the autos? Because the president mentioned last night he'd spoken to the autos CEOs. Is it carve-outs we should be thinking about here?
Yeah, I think it's by product, by region. Remember, the USMCA, right, the United States, Mexico, and Canada agreement set up some policies that said you've got to have a certain amount of U.S. content in your products to be USMCA compliant. So I think he's thinking about those categories, the USMCA compliant. And doesn't that make sense to you, right? If you complied with the agreement, then maybe you avoid tariffs. And if you didn't comply with the agreement, well, you did so at your own risk. You knew you weren't complying, and therefore it seems likely that's a place where the president will go. Again, the president gets to make the decision. I'm there talking with him about it, and so is the team. But our expectation is that it'll be categories. It will be 25%, but there will be some categories left out. It could well be autos, could be others as well. USMCA, go look at that. That was the agreement we made with US, Mexico, and Canada, saying those products are exempt. Everyone who didn't live under those terms and did so at their own risk and knew they were doing it at their own risk always.
Secretary Lutnick, good morning. Would you say right now that you think that U.S. autos like GM and Ford are compliant under USMCA?
That is my understanding, is the big three say they produce cars that are compliant under USMCA, which means they have sufficient U.S. content in them to be part of the USMCA agreement. So I think that's part of our discussion, and the president's really thinking about that.
So it's fair to assume then, especially given the constituencies of auto workers that the president was able to pick up in this past election, that it is the auto industry that could potentially get that exemption later this afternoon?
It's not really an exemption. Remember, we're trying to end fentanyl coming into the country. So we're trying to send a message that fentanyl has got to end coming in from Mexico and Canada. It's just has to end. And they've done a reasonable job on the border, and they're going to do a better job on the border. But this is, remember, it's a key about fentanyl for this month. April 2nd, we could talk about the rest. But this month, it's about fentanyl. And the president's trying to give Mexico and Canada some statements, some move forward, because
They are trying their hardest, and we believe they're trying their hardest. But the fact is that we're going to put something on because deaths in America have not decreased in a way that is sufficient. Deaths of fentanyl and opioids in America.
Many families will sympathize with this remarks. Me, myself, I know families who have been at the end of the suffering when it comes to fentanyl. But yesterday, though, the president questioned the fairness of Canadian banks. So what is it about? Is it about Canada's banking system, or is it really about fentanyl?
So this month, right now, is about fentanyl. When we talk about April 2nd, we will talk about the bigger trade picture between our trading partners, Canada, and our trading partners in Mexico. So April 2nd, I'll be happy to come on and talk to you about our thinking and our thoughts about a broad trading model. But right now, it's about fentanyl. This is a drug-related issue. Drugs coming into the United States of America have got to stop. The border has got to remain closed. That's the key of how you treat your great trading partner. You treat your great trading partner with respect, and you stop letting fentanyl into the country. So my view is the president is thinking about it. He's thinking about autos. He's thinking about USMCA. He's going to come up with a plan this afternoon. We're going to announce that plan. I think it's going to be in the middle. Somewhere there's going to be 25% tariffs. It's not the middle as in a number. I think it's the middle in terms of USMCA and not USMCA. But the president will decide that this afternoon, and then we'll go on from there. But think about that. If you were compliant with USMCA, you did what President Trump asked in his last term. And if you weren't compliant, you did that at your own risk.
Secretary Lutnick, I just want to make sure that I understand this correctly. You're talking about the idea that this all has to do with the drug wars. And at the same time, some people have speculated that this could lead to a renegotiation of USMCA that would lead all around to even lower tariffs than before. Are you saying that's off the table, that tariffs are still part of this at the 25% level?
Well, remember, April 2nd, we begin our reciprocity model, which is how you treat us is how we treat you. And that is going to be part of his exemption, part of his tariff policy. And then he's got industries, autos, semiconductors, pharmaceuticals, steel and aluminum and copper, lumber. These issues need to come home. We need to help our domestic industries grow and flourish. And so we called out those product sets for extra focus. But that's April 2nd. So on April 2nd, our reciprocal trade policy will come out. In 2026, we renegotiate USMCA with Canada and Mexico, and we're going to have really clear analysis and clear focus on how that changes. But right today, let's be clear, today is about fentanyl.
We heard from last night the president. He said that he was fine with a little disturbance, but going forward, there will be all of these gains realized. Secretary Lutnick, are you concerned about the level of uncertainty expressed, not just in markets, but just even from people who you used to work with, where they're saying we don't have a clear sense of what the goal is? And I understand you're saying it'll come on April 2nd. But in the meantime, people are just putting all plans on hold.
Well, I'm not seeing all plans on hold. In fact, I'm seeing the opposite, right? We saw Apple commit to $500 billion. We saw OpenAI and Oracle commit to $500 billion of investments. TSMC just the other day saying $100 billion investment in America. SoftBank, $200 billion investment in America. So $1.3 trillion, and you think people are waiting on the sidelines? We feel it every day. All these companies are coming. They're building in America. They're committing to America. We agree April 2nd is coming. We have to do our work before we announce our plans on April 2nd. Of course, we have to do our work and do it properly and do it thoughtfully. But in this period of time, America needs a president to protect people from fentanyl. It shouldn't be killing people in our country. China still has fentanyl as a highest list of subsidies. They subsidize the production of precursors, the ingredients to fentanyl. They send it to Mexico and Canada, and into the country it comes. So our president has said Enough already. Enough already. And that's why he's come up with this tariff plan today. April 2nd will be a fairness plan. And fairness plan is not that hard to figure out. If you have a
Secretary Lutnick, can I jump in there on the fairness plan? Is that an initial partial assessment and response, or will tariffs actually hit on April 2nd?
Well, there are a whole variety of laws in the United States of America that we will follow with precision. Some tariffs will come on right away, and then some tariffs will be registered, and they will take 3 weeks or 4 weeks, and they will come on in due course. So there's a process for tariffs in America, but we will announce them, and we will be negotiating with all these countries thereafter, and then they go into effect over a period of months. So basically,
because,
April 2nd, we will announce them, and then they come in.
Because there's months of studies, massive report, public opinion. This can take a very long time. So legally, there's no law that's short enough, really, to put tariffs in place on the 2nd. So how long between April 2nd until the tariffs actually hit do you think we'll see?
As I said, we launched our studies on January 20th. So April 2nd, those studies are done. Some tariffs can come straight away. Some can come weeks later. Some can take over a month or two to come online. But it will be very, very thoughtful, very organized. And we begin on April 2nd. We've announced it from January 20th. That April 2nd was the day. We're sticking with our day. We're sticking with reciprocity. It is time for America to be treated fairly. And that's what President Trump is going to do. He's going to make sure we are treated fairly. He's talked about it last night. He's made this clear. So Mexico and Canada is about fentanyl today for the month of March. But on April 2nd, it's about fairness. And yes, that is a process that comes in that is strictly specific to the laws. But it'll take over a month or 2 months to come in. But once it's in, they will stick, which is treat us fairly, treat us properly, or don't trade with us.
Mr. Secretary, I was a man of my word. I am a man of my word, and I promised we'd come back to the address last night, so let's finish there. The President of the United States talked about a big, beautiful drop in interest rates. A lot of people in this market are curious whether the President is no longer sensitive to the deadly gyrations of the equity market, that the focus, the emphasis now is on the bond market. Is that the shift? Is that the way to understand things?
No, I think that is too specific. I mean, let's face it. If we balance the budget of the United States of America, interest rates are going to come smashing down. And I don't mean 10 basis points. I mean 150 basis points. You're going to have an explosion in the housing market. You're going to have an explosion in the equity markets, because this is not a manufactured cut in interest rates like you saw last time with this huge money supply, which created the vast inflation. This is the right way to do it. You stop printing money. You stop running deficits. You balance the budget of the United States of America. You smash interest rates down. You produce enormous amounts of energy, drive those prices down, and you will see the greatest equity market and the greatest economy in the United States of America. Now, remember, this president is worried about the United States of America. Sometimes I get asked questions about, am I worried about Canada? Am I worried about Mexico? And am I worried about the EU? My president is worried about the United States of America, and you are going to see the greatest equity market and bond markets under President Trump.
Well, let's worry about the American data right now, because equities have rolled over just a little bit. You know the market well. I won't make a big deal of it. We're just a bit softer at the back of this data from ADP, which is a downside surprise at 77K. The estimate was 140, so we're sub 100. We'll see what we get on the ISM later on this morning and on payrolls on Friday. But as you know, Mr. Secretary, the data over the last few weeks hasn't been great. The survey data has been softer. And a lot of these companies in these surveys have pointed to tariff uncertainty. Do you accept that the business community needs some clarity? Or whether it's 25, 15, 10, whatever the number is going to be, that the volatility around the trade story, the cumulative effect of persistent uncertainty is starting to eat into this economy a little bit?
No way. I mean, the president spoke about it last night. He said Biden left him a pile of poop. Okay, he left him a lousy economy that he's trying to fix. You're looking at data that's Biden data. Do not try besmirch my President Trump with Biden's nonsense.
You think the ISM manufacturing
number
is Biden data? I just want to be very clear. That's your opinion. You're entitled to it. You think that's his data and not yours?
Of course it's my opinion.
Okay.
What possible could change? Seriously, we are in early March. My president took over January 20th. You think economic data coming out in early March is Donald Trump-related data?
Monthly survey data?
You gotta be kidding me.
Mr. Secretary,
Stop it.
Are you suggesting, we don't have to get into an argument about it, are you suggesting that when bond yields drop in a market that's worth trillions of dollars and investors place bets off the back of that economic data, that data doesn't count for anything, that data is somehow misleading?
I think that data is leading you to understand if Joe Biden was still in charge, you'd be in trouble. But you have a new president, there's a new sheriff in town, and I would bet on the economic growth that is coming from Donald Trump. You see the investments. You see it already. There's trillions of dollars of manufacturing moving to America. It's moving to America. That means the cavalry is coming. For every $1 trillion that invests in the United States of America, that produces 1% of GDP growth. Imagine that. You have a president bringing GDP growth directly to his economy. That's amazing.
Mr. Secretary, we appreciate your time and your opinion. As always, sir, the US Commerce Secretary, Howard Lutnick there on the economic data, financial markets and what's going to happen with trade. Equities are a little bit softer on the S&P. The data is a little bit weaker. We'll see if the ISM services print later on this morning confirms that weakness. And we'll go into that survey data and see what the business community says about why things are a little bit weaker, if indeed they are weaker. Then on Friday, we get a payrolls report as well. Look out for payrolls on Friday. The hard data is going to matter. The softer data is softer. Will it bleed into the hard economic data? But we need to pick up and recap what we just heard there in that interview. Some important comments. And Annmarie, I want to bring you into the conversation because as the Commerce Secretary was speaking, I was looking at the shares of Ford, the shares of GM starting to pick up, starting to bounce, because we got some clarity there on what might change this afternoon.
A relief for the big three automakers, isn't it? President Trump said last night he spoke to them. Howard Lutnick said today, the Commerce Secretary, this isn't really about the tariff rate. It's about whether you're not USMCA, the trade deal between the United States, Canada, and Mexico. Are you compliant? He said he thinks those auto companies are compliant. So potentially this afternoon, the Commerce Secretary said this afternoon, we're going to get some more information. It sounds like to me that the auto companies will be getting an exemption or a carve-out starting today.
We will get that announcement, Lisa, at some point later on today. That came from the Commerce Secretary just moments ago.
It raises questions about how many companies out there are not USMCA compliant, what the ultimate goals are. He also continued to repeat that the tariffs that have been discussed so far, the 25% in Mexico and Canada, have to do with the trade war. The larger sense of where the tariffs are going, the trade renegotiation will happen on April 2nd. That's where the grand plan in terms of the tariff levels will be unveiled. So hold tight on that. This is just the drug war. At the same time, I think a lot of people are looking at, okay, well, what will it actually look like in practice for companies that need to put it into effect?
As for those companies that have reported and are quoted, cited in the ISM survey, they're pointing to the uncertainty around trade. Now, the Commerce Secretary is perfectly entitled to disagree with those comments and say this has nothing to do with them. But it's in the economic data. And I've said this a few times. I want this administration to succeed. I want anyone in the White House to succeed because it's for the good of the country that they are successful, that you see investment, that you see hiring. But a scorecard so far, I agree with them on one thing. We're only 5-6 weeks into this. We only have so much economic data. But the scorecard so far, the soft data, the survey data, hasn't been great. Lisa, maybe that changes in the coming weeks and months. I hope it does, but it has been softer so far.
Which is the reason why the ADP report that came in below expectations had a market move, because people are sort of attuned to this. I do wonder when they start to look at the data that comes in as Trump data, how long can it remain Biden data? And at what point is it something that is directly reflecting policies that have gone into effect or a lack of policies, but really the policy uncertainty? We don't know yet. And I agree with you. I hope that there is a strong economy, and I hope that we do not see layoffs, because that is not good for anybody. And that is the reason why I think we're all watching with bated breath.
On the data, let's get to Mike McKee for more. Good morning, Mike. What'd you see?
It's a little bit of a weird report ADP put out today, lower than anticipated at 77,000 jobs, but it's the makeup of the report that is interesting. We saw a big increase in manufacturing, 18,000 jobs, construction, 26,000 jobs. That was not what we saw in the ISM manufacturing report earlier this week. We see a loss of 28,000 jobs in education and health services, which is normally the biggest gainer in all of the categories in the non-farm payroll report. So I'm not sure how much sense this all makes. The one number that does make sense is a loss of 25,000 jobs in the Pacific region, which would square up with perhaps the Los Angeles fires costing us some employment. But it's going to be interesting to see now, not just what the number we get on Friday is, but where the breakdown is and how ADP matches up with that. It's going to be all about what the overall number is telling us rather than the headline number itself.
Mike McKee, thank you, sir. Let's extend the conversation. Let's talk about retailers. Chuck Grom of Gordon Haskett joins us now for more. Chuck, welcome to the program. Tariffs and big changes in the last 24 hours and no amount of certainty about the future, Chuck. I just wonder from your perspective how the likes of Target, Best Buy, the companies that fall under your coverage will make changes, if they make any changes at all, in the coming days and weeks.
I mean, Target admitted yesterday that if the prices of goods go up in Mexico, they're going to have to raise prices almost immediately. So, we'll see in the coming days and weeks. The consumer clearly is under stress over the past couple of months. We're seeing that almost across the board, whether it be Home Depot or Lowe's, whether it be Target yesterday. Even companies like Ross Stores, who have been very strong, last night had sales that were weaker. So the consumer's under a lot of stress. We're trying to unpack and double click on exactly what's going on. Certainly these headlines down in Washington aren't helping out, but the weather hasn't been good. Flu cases have been at all time or close to 20-year highs. So there's a lot of moving parts right now.
Chuck, this raises this question. Is this sort of embedded weakness that was already set in motion, or is this due to policy uncertainty? How are you gleaning the difference between the two? And the reason why it's important is because one is backward-looking and one is forward-looking.
Well, if you go back and look at the holiday itself, it was really strong, almost across the board. So what it looks like we're seeing right now is a little bit of a hangover from the holiday, but almost unequivocally across the board. The holiday was great. So when the consumer needs to show up, they're showing up. The lulls just look like they're deeper right now. There's really no reason to go out and shop. And like I said, the weather in February was really, really bad.
How much are the retailers compliant with USMCA? And I ask this because it sounds like these tariffs on Mexico and Canada will be removed for companies that are in compliance.
That's a great question. I don't know that off the top of my head. Most of my companies are domiciled in the U.S. And, the companies that have international exposure, the Costco's, Walmarts of the world, Home Depot, Lowe's to a degree, I would believe they are compliant.
Hey, Chuck, appreciate it. Chuck Grom of Gordon Haskett.
All right.
We'll get more details a little bit later on this afternoon. We heard from the Commerce Secretary about 20 minutes ago that we get that announcement, more clarity on just how big those tariffs will be. We understand they'll stay at 25%, but certain industries, certain places, those tariffs won't apply.
Yeah, meet in the middle doesn't mean 15%, doesn't necessarily mean 12.5%. It means that there will be carve-outs. That is the implication. Is it USMCA compliant? And then how do you determine that at a time when it seems like if it was in law and somebody wasn't complying, there are the tools. Again, it goes down to the point of when do we get a framework that people can use to understand and preempt some of what might be coming up down the pike from Washington, D.C.
Coming up on this program down the pike, we'll be catching up with David Mericle of Goldman Sachs in just a moment to get his call on the jobs data on Friday. And we'll catch up with Mike Schumacher of Wells Fargo. We've got some major moves in this bond market. This is a really important moment for the global economy. Bond yields in America have been falling for 7 consecutive weeks. In week 8, they're a little bit higher on a week so far. Over in Europe, in Germany, yields are higher now on a 10-year by 23 basis points. The 10-year, 272. From New York, this is Bloomberg. 60 minutes away from the opening bell, equity futures on the S&P just turning negative on the S&P 500 following a downside surprise on the ADP report moments ago. A little bit later this morning, ISM services at 10 a.m. Eastern time. Then after that, tomorrow morning, the payrolls data. The soft data has been softer. Let's see if this really starts to creep into the hard data. Jobless claims tomorrow morning, another one to look for. Let's get you some movers going into the cash open. With more, here's Manus Cranny. Hey, Manus.
Jonathan, thank you very much. Great conversation there with Mr. Lutnick. Not our data at the moment. Have a look at this. General Motors is on the up. Compliance is everything with the US MCA. And we'll find out later on today, post that conversation, carve-out, exemption, quasi-carve-out. We'll find out the calibration of what these tariffs really look like for Canada and Mexico. Roll it over, have a look at Tesla. This is about production and politics. We know the political story in Germany. Sort of a backlash against backlash against Elon Musk. Their sales fall by 76% in Germany. That is about recalibrating production in Germany, the Model Y, etc. And their sales rise by 11% in the United Kingdom. What's the Elon put? Have a think about that. I'll leave you the CrowdStrike. You might have been stuck at an airport last summer when the software didn't exactly go according to plan. That is cost. Dollars. $60 million. $21 million in the last quarter of the year. Well, the CEO, despite this drop by over 8% this morning, says everyone loves a comeback story. It's just not in the price this morning. John.
Manus Cranny. Appreciate it, Manus. Thank you. Some of the movers going into the opening bell. Whose economic data is it? The politicians can argue over all of that. What does the data say about where we are?
Well, this I thought was interesting. We did get the ADP report coming out with 77,000 jobs. It was down from the expected 140,000, and it was the weakest going back to July. Neela Richardson, who is a friend of the show, chief economist at ADP, said our data, combined with other recent indicators, suggest hiring hesitancy among employers as they assess the economic climate ahead. Is it their data? We shall see. But right now, there is clearly a tone of uncertainty coming out of corporate C-suites.
The data speaks for itself. The politicians can argue about whose data it actually is. Markets are going to trade on the economic data as it is. And right now it's a bit softer. I would say we had a head fake last summer, particularly with employment and unemployment starting to creep higher. We'll see if this is a head fake. See if it's just a soft patch we come out the other side of. But this is all we've got to go on so far. It's not much I know, but this is it.
And if there is certainty given on April 2nd in terms of a framework for tariffs, does that remove some of the uncertainty to allow plans to go forward and allow some of the dynamism that people have been talking about to move ahead? That is really a key question right now.
The U.S. Commerce Secretary Howard Lutnick joining Bloomberg Surveillance just moments ago, telling us that a decision on Canada and Mexico tariffs, an update on that decision, will be announced later on this afternoon. So look out for that. Joining us now is David Mericle of Goldman Sachs. David, welcome to the programme, sir. Just to recap the economic data from the perspective of you and the team, where are we now and how have things changed over the past few weeks?
Yeah, I would say more has changed on the sentiment side. We begin to see some surveys come down from peak post-election optimism. I don't think we've yet seen substantial weakness on the hard data side. We did see 1 month of weaker consumer spending data in January, although I would just highlight that follows 6 extremely strong months, and that January, because of weather effects, because of the holidays, can be a bit of a volatile month. Beyond that, I would say we're still kind of waiting to see, and we'll see a bit more on Friday, what the impact of the policy uncertainty is on both the hiring side and the capital spending side. I think that is probably the key question going forward.
This is important, David. Are you saying that if we get a weaker number on Friday for non-farm payrolls, that it could reflect the uncertainty that we keep hearing from a lot of corporate executives? Or are you saying that there was weakness already in the system that will come to fruition? And it is important what we can attribute that to.
Sure. Look, I think it's always probably a little bit excessive to draw too much from just one monthly payrolls report and attributing, where any strength or weakness came kind of to recent policies or to a couple of months back, I think would be very challenging. What I would highlight and what I think a lot of investors are focused on is that over the last couple of years, healthcare and government have played a very outsized role in hiring in the U.S., in net job growth in the U.S. And those are two industries that might be particularly exposed to some of the recent policy uncertainty. On top of that, we saw in the recent ISM manufacturing survey that companies like consumers, are very attuned to the recent policy news. There were 20 mentions of tariffs in the ISM manufacturing report. So, I wouldn't make too much of just the February report, but I think in coming months, we'll begin to see what possible effects there are of changes to tariff policy, changes to immigration policy, and changes on the fiscal side as well.
We've seen the beginning of revisions of certain analysts' expectations going forward across Wall Street. As we just heard, for example, Ed Yardeni saying that he thinks that the chance of a melt-up in stocks is a lot lower, and that he thinks that there is probably a greater chance that there could be more of a weakening in the economic data. Do you have enough information so far to adjust your estimate for the remainder of this year, or are you sticking with a call of a good deal of strength?
Yeah, well, we're looking for GDP to grow kind of close to a little. We have a forecast that's still a touch above the consensus of 2%. But I think everyone is kind of in the same ballpark, waiting to see what happens on the policy side. The last couple of years, the economy grew at a very strong pace. Part of that was because immigration and therefore labor force growth were much higher than they usually are. That's not going to be true going forward. We're going to see labor force growth, job growth, and GDP growth slow. I think everybody agrees on that. Growing somewhere in the neighborhood of potential growth at around 2% was kind of our expectation coming into the year. What we're most focused on now is trying to understand whether the tariffs that were announced recently and that we might get going forward will wind up being meaningfully larger than what we had anticipated on Inauguration Day. Like most forecasters, we had made some allowance for tariffs. Some of those have come through, like the 20% increase on imports from China. But I think that the key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated. That would probably be something that could lead us to see more downside risk to the economy. Perhaps not dramatic, but it depends on the magnitude of the tariffs.
David, what about the uncertainty? What if the uncertainty around tariffs persists for longer than you anticipate? How much damage does that do?
Yeah. This was a question that markets worried about even back in 2019 in the first trade war. And I think for a couple of reasons, the risks this time around are probably larger. For one thing, the tariffs that are being proposed are just a lot larger than what we saw last time. In fact, the tariffs that have already been implemented are considerably larger than what was in place last time. The other more subtle point is that we've found in our research that U.S. industry and Chinese industry don't overlap that much on the input side or the output side. And retaliation in the first trade war came mostly from China and was mostly directed at agriculture. I think the risks for companies from the uncertainty now are a little bit larger because obviously U.S., Canada, and Mexico do have more interlinked production chains. And if you think about some of these other proposals, the reciprocal tariff, the critical imports tariff, possible tariffs on autos or on the EU, there too, I think the exposure of U.S. companies on both the input side, the output side, and on the potential foreign retaliation side, where now you need to think about what many foreign governments might do in response. All of those risks are higher, and so the uncertainty really ought to be more meaningful to U.S. companies' business decisions.
So many different variables to try and figure out. David, thank you, sir, for an update. David Mericle of the team over at Goldman Sachs on the economic side of things. Equity futures just a little bit softer, still positive on the session. Some softer data about 20 minutes ago from ADP. March 19th gets very interesting for the Federal Reserve. That two-day meeting concludes 2 weeks today. Mike McKee, our economics and policy correspondent, joins us now for more. Mike, the data is what the data is. It's all we've got. And I know we're only a month into this, but I wonder where we'll be by the time we get to that Federal Reserve meeting.
I suspect we'll be about where we are, John, given especially what Howard Lutnick was just saying about we're going to make some adjustments this afternoon, and then the real tariffs come on April 2nd. Even though the Fed has some detail now to work with about some tariffs, there's still a lot more they don't know. That's what John Williams' point was yesterday in his interview with us. He said, we do know that tariffs are inflationary. We do expect inflation out of this, but we don't know how much because we don't know how long the tariffs will last, how many other tariffs will be put on, and what what costs they're going to impose on the economy. So they're not much better off, put it that way, and they won't be by the 19th than they are right now.
You were speaking, Mike, yesterday with the Fed's Williams, and it was a great conversation. It was an interesting nuance that he had about inflation and how it would affect their thinking. How much of the mainstream does he represent, and how would you characterize how this does color the path of rate cutting ahead?
Well, I think he's probably in the mainstream in the sense that what he was saying is tariffs are inflationary, but we don't know, because we don't know what the president's plans are, whether that inflation carries through. In other words, we're going to get a rise in the price level, and that's what some members of the Fed have focused on, like Chris Waller. Now, does that continue because you have a sort of rolling series of tariffs coming through, or is it that one-time price level rise that the Fed can look through? They just don't know that yet. And at the same time, they're keeping an eye on the overall economy and whether it's rolling over. The data, as we've been talking about, David Mericle was talking about, are getting softer, but the hard data we haven't quite seen a lot of evidence on that yet. So the Fed is basically going to sit tight on March 19th and not do anything. I thought one of the interesting things we talked about, Lisa, in terms of monetary policy going forward was the summary of economic projections and the dot plot. And basically, John Williams said they're not going to mean a whole lot, just like they didn't in December, because we don't have visibility going forward.
They never do, but we produce them anyway. It's kind of frustrating, this whole thing is. Michael McKee, thank you, sir. Appreciate it. Let's check out the bond market together. Stateside versus what's happening in Germany. In America, bond yields are lower. The front end of the curve, we're down by 7 off the back of that weaker than expected economic data from about 20 minutes ago here in the United States. In Germany, we're up big, up by double digits. That divergence we're seeing, yields up in Germany, down in the United States. Mike Schumacher of Wells Fargo joins us now for more on that. Mike, it's convergence. Germany's coming up to the United States is coming down to Germany, just in terms of bond yields. How much more convergence are you and the team expecting?
Could have a fair amount, John. It's interesting. I'd say it's actually a structural shift in Germany. I know it sounds dangerous to say. People have talked about defense spending rising for years, but it's actually happening. The numbers are big, on the order of 1% of GDP incrementally for a number of years. So that's a huge change in Europe. I can imagine other countries get on board, and you see really what we think could be a massive shift as far as more issuance, higher real yields, and therefore pushing up European yields toward U.S. levels.
It's a huge change for Europe. It's a huge change for fixed income. Mike, additional issuance from a country that typically doesn't do deficit spending and celebrates the so-called black zero, balanced budgets. When the money starts to go towards Germany to finance that deficit, Mike, how do you think about where it's coming from? How the flows start to change?
Yeah, it's got so many implications, John. It's interesting. So one is ECB. ECB meets tomorrow. And for years, I and a lot of people have said the ECB is really the only game in town as far as actually easing when Europe's got a difficult time economically. Maybe that's not so much the case anymore. So maybe the ECB will get more help on the fiscal side, and it won't have to be as aggressive doing rate cuts when times are tough in Europe. That's just one aspect. You can also think about investors globally, for instance, in Japan, who would say, well, if I want to invest overseas, I have many options. I want to go to a liquid market, so U.S., Germany, France, et cetera. Maybe the U.K. would be candidates. Now Europe looks more appealing. So lots of nuances to the shift by the German government.
One thing that you said, Mike, was that you might see a convergence with German yields, European yields coming up to where U.S. yields are. I wonder how it affects U.S. yields and whether just developed market yields globally have to be reset a bit higher, or at least stay where they are, to absorb all of the deficit spending that we're seeing around the world.
Yeah, it's a great point, Lisa. I think there's a gravitational pull. So we haven't seen that today so much because there's just such an incredible news flow out of the U.S. as well. But if German yields go up and sustain an increase, not matching U.S. yields, but rising a bit more, and if that happens in the U.K. as well and some other markets, I do think that pulls up Treasury yields and yields in other markets that seemingly are less affected, Canada, et cetera. So yes, more issuance globally, higher real yields, that should impact all bond markets across G10 to some degree.
Mike, earlier this morning we were speaking with Bob Michele of JPMorgan, and he had a pretty exceptional line that he believes dollar exceptionalism peaked this week, and that you're going to start to see money flow out of the United States, and that dollar long and dollar asset long really start to get eaten away and money transferred elsewhere. Do you agree with that?
Not yet. I think that's premature. And one reason I say that, Lisa, is when you think about the depth of the capital markets here, it's extraordinary. So when we talk to clients globally at Wells, when they want to reallocate risk, they almost inevitably do to the U.S. So if there's a flight to quality, if there's a safe haven move, people will say, well, if I want to move X billion in government bond risk, I need to go to the U.S. markets because they're so deep and they're so available. I would make the same statement about U.S. equity markets. So capital market depth is something that won't change very quickly here. Could the dollar lose a bit of luster? It already has. So dollar euro is at 107. After the news last night, we think it goes up towards 110. We were bearish not too long ago, but the facts on the field have changed, so our view has changed also.
You weren't alone, that's for sure, Mike. Appreciate it. Mike Schumacher there of Wells Fargo. There were good reasons to be short Europe. You were facing an economy that was basically stagnating, an ECB that was lost somewhere, and they can work out where they were. A German government that wasn't going to do much anytime soon, and all of a sudden, the president comes in the United States and makes a much bigger push on two fronts, I would say. A push to secure peace in Ukraine, and also a push on the trade front as well, which has developed two issues. One in Germany, more spending, and another in China, more deficit spending. They're two big shifts off the back of this change that we've seen in the White House.
There is an acceptance that maybe countries need to rely more on themselves and their local partners if there isn't necessarily going to be the same structure that they've relied upon in the past. The idea that you could have the German government, the incoming chancellor, talk about 500 billion euros of spending on infrastructure in addition to potentially a blank check for their Defense Department is massive and fundamentally shifting a lot of people's views on this market.
President Trump wanted more defence spending out of Europe. He's about to get it. Secretary Bessent wanted to see the Chinese economy rebalance. Based on her comments overnight, he's about to get that too. Euro dollar right now, 107.07, with an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. On the point of Germany, Germany will amend its constitution to unlock hundreds of billions of euros for defense and infrastructure investments. Chancellor in waiting, Friedrich Merz, has planned a 500 billion euro infrastructure fund that will invest in priorities like transportation, energy grids, and housing over 10 years. Elsewhere, Disney is cutting about 200 jobs across its ABC and entertainment TV networks. An internal memo seen by Bloomberg outlines cuts that mostly impact the ABC News division in New York, with production teams for ABC News Studios, 2020, and Nightline set to be consolidated. In its earnings last month, Disney broadcast and cable TV businesses saw a drop in revenue and profit. LeBron James made NBA history last night by becoming the first player in league history to reach 50,000 points. The 40-year-old came into last night's game against New Orleans needing just 1 point to reach the threshold. He finished the game with 34 points in a Lakers win. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. More economic data still to come. And we'll bring you some highlights from our conversation with E-commerce Secretary Howard Lutnick from earlier this hour. From New York, this is Bloomberg. $40 minutes away from the opening bell. Equity futures on the S&P 500 just about positive, softer off the back of what we saw 40 minutes ago. The economic data in America, ADP coming in weaker than expected. Lots of economic data still to come. Still to come later this morning, 10 a.m. Eastern Time. Look out for ISM services at 1 p.m. A White House press briefing. Then tomorrow, another round of jobless claims plus an ECB rate decision. Friday, the big data point, payrolls Friday just around the corner, and comments from Fed Chair Jay Powell. Ahead of comments from the White House this afternoon, we caught up with the U.S. Commerce Secretary Howard Lutnick, telling us earlier on Bloomberg Surveillance about a potential shift in tariff policy.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle.
That last line there, somewhere in the middle. Annmarie joined us now from Washington, D.C. We got some more clarity, some detail on that, Annmarie, just what somewhere in the middle actually means.
It sounds like what it means is that if you are USMCA compliant, you will get some sort of relief today. And the Commerce Secretary Howard Lutnick saying that announcement could come as soon as this afternoon. Somewhere in the middle sounds like if you're, say, GM or Ford, and you've been on the phone with the president, as the president told us last night as a joint address to Congress, he spoke to the automakers, and you've been making the case that we have a intricate supply chain. We are USMCA compliant. This is your trade deal from Trump 1.0. You have to give us relief. Sounds like that auto sector might get that today.
And GM and Ford shares are up on the day as they do look forward to some sort of potential carve-out. Annmarie, I'm just curious what you thought of this sequencing, the idea that right now it's a drug war, and on April 2nd it will be the full regime of trade renegotiation that a lot of people have been trying to plan for.
He said the magic word that I've been hearing from officials, whether on the record or behind the scenes. It's about reciprocity, especially when it comes to April 2nd. Now, we also got a little bit more details from the Commerce Secretary what April 2nd actually means. This could take months in terms of actually having the legal framework to enact tariffs. It sounds like when it comes to April 2nd, for some industries, for some countries and products, they might have to announce what they plan on doing, but it might take months until the actual tariffs come into place. And he said for others, it might actually be on April 2nd. So that's going to be fascinating. What tariffs actually hit on April 2nd, while others are just signposting of the tariffs that can come down the pipe.
Annmarie, appreciate it. Looking forward to your coverage throughout the day on Bloomberg TV. Annmarie Hordern there of Bloomberg Surveillance down in Washington, D.C. Where do we begin this morning? I want to talk about Germany just briefly. Still seeing a 20 basis point move on a German 10-year yield. Nothing's done until it's done. Let's see if this gets through the German parliament. But certainly the potential for a major regime shift in the largest economy in Europe.
Which is the reason why German borrowing costs are surging the most. As you pointed out, since 1997, this whole idea that this is a new post-reunification Germany that has a very different kind of schedule may be pushed into it, frankly, by President Trump. And there is a question about be careful what you wish for, because is this giving people a lot of hope that actually Europe will see green shoots of growth?
They need some insulation as well, because potentially in early April, and this takes us to the trade conversation, we'll see those reciprocal tariffs. So what we're hearing now on Mexico and Canada is different. The Commerce Secretary explained why it's different. You'll see something else in about a month from now.
It's hard to know exactly what's going to stick. If it's different than the 25% that does stick on non-USMCA compliant companies, how does that fit into the recalibration that we get on April 2nd that gives a sense of what fairness is? And we heard from Ed Yardeni earlier. He was asking, does this mean we could potentially reset to lower tariffs all around? Unclear that that could be the goal, because tariffs are going on, and that has been a goal of this president.
And we'll see how the economy responds in between. We've said this a thousand times, that the end destination could be a good one. This is the start of the journey. We've only got so much data to go on at the moment. The survey data has been softer. We'll have more data a little bit later. ISM services is going to be really important. Does it confirm or deny a recent soft patch for the US economy in the service sector?
Which we saw in the manufacturing sector with prices paid also going up. In the services sector, you already have heard about the idea that there are restaurant operators that are concerned going forward. But we have seen time and again that sentiment doesn't translate into action. And if people feel bad, they also say, well, maybe we shouldn't go out to eat tonight. I mean, this is the kind of stuff we'll find out about.
We've had a few head fakes over the last year. Let's see if this is another one. More economic data coming later this morning. Jobless claims coming tomorrow. Payrolls on Friday. Tomorrow morning, we'll catch up with Mark Giannone of Barclays, Jill Carey-Hall of Bank of America, the former chair of the Council of Economic Advisors, Jason Furman, and Andrew Sliman of Morgan Stanley. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to a special BNP Paribas Open update for Bloomberg TV and Radio from Tennis Channel. Defending champion Carlos Alcaraz heads into the California desert looking to make history and become just the third man to win 3 consecutive titles at the event. On the women's side, newly minted Aussie Open winner Madison Keys returns to the WTA Tour on a 12-match win streak after her victories in Adelaide and Melbourne.